See if this one works. Multi-stream. That might work. This one here. What do we got going on here? Sort by newest, customization. That on. Sorry about that this morning, guys. Give me just one quick second here. I've got I don't know if it's Streamlabs or internet related. It's one or the other, but I rebooted the internet and Streamlabs, so this should be good to go. Good morning. How y'all doing out there? Go Lions.
CNBC.
Retail in focus as investors continue to watch for cracks in what has been a surprisingly strong consumer. I sat down with Ralph Lauren CEO Patrice Louvet last week in Davos. We discussed his outlook for the company heading into 2024, the global market, and of course, the hottest topic this year, artificial intelligence.
We're cautiously optimistic as we get into 2024. I think one of the things that really has characterized the work we've done with Ralph Lauren in particular is our ability to build in resilience into our business model, into our brand, so that you can count on Ralph Lauren irrespective of what the environment will look like. And we've had to navigate COVID, we've had to navigate the inflationary pressure situation, and so we feel confident going into 2024.
How has your business changed most since COVID? It really was a reckoning for retailers like yours and a test of leadership.
Yeah, I think there are a few areas that have evolved for us. First of all, if you look at the way consumers have been shopping, right, there's been a pretty significant pivot that we all have to make towards digital. And that's been a big new capability for us. And it stayed, right? About a quarter of our business now is digital. The second area is you look at how people dress, right, and what's changed there. And you hear a lot about quiet luxury. And I think in times of uncertainty, consumers are gravitating towards brand they know, products they trust. And so we're seeing that clearly evolve as consumers move to more sophisticated casual dressing. And then I think, we've just learned to build a bigger agility muscle, right? And obviously we have supply chain challenges as we speak with what's happening in the Suez Canal. And I think one of the new muscles that the company has developed is this ability to just be nimble and be agile.
Just a heads up here on a 30-minute basis, Spoos is looking for a roll here, roll to the downside.
We're driving that successfully. China, as you and I have talked in the past, is a major opportunity for us. China today is about 6 to 7% of the company. Pre-COVID, it was around 3%, so we made good progress. But when you compare the penetration of luxury companies and China, it's more 20, 30, 40% of their business. So I think we have a lot of runway in China. Southeast Asia in general is a significant white space opportunity for us. And then we're starting to plant seeds in India. I know that's a topic this week, right? But with really a lens to the next 10 years and the next 20 years to make sure we're building the right brand positioning, the right brand equity, so that we can benefit from that in the many decades to come.
China's been a really good story for you and a growth driver, as you mentioned, even amid questions last year and going into this year about the strength of their recovery, how much China's willing to add stimulus to juice retail sales and economic growth. What are you seeing on that front?
Yeah, China's been has been consistently strong for us. You saw that in our last quarter release. I think what the team is doing really well there is we're very focused. We focus on top 6 cities, right? Taipei, Hong Kong, Shenzhen, Chengdu, Shanghai, Beijing. We are building consumer-centric ecosystems with a flagship store, polo boutique, surround sound digital, quality wholesale. On the product front, this is where we sell our most elevated product, actually. Our most expensive cashmere sweaters are actually loved by our Chinese consumers. And so we're leaning into that. We've also seen really nice diversity in terms of the makeup of our customer base. It's a younger consumer, more diverse from a gender standpoint. And I think the team is doing a great job bringing our purpose to life, which is global and universal, and weaving that into the Chinese culture.
You said the most high-end cashmere sweaters.
Yes.
How much is a high-end cashmere sweater?
Oh, there's a broad range, but you know, if you're ready for it, you could spend $1,000 or more on that.
I'm asking because I do wonder why Ralph Lauren doesn't get the valuation of some of the European luxury companies, which it feels like you're trying to play in that area and competing against.
Yeah, so we've made good progress on valuation. Obviously, we want to continue to drive that, and our goal is to be associated with the key luxury players. I think, you know, when you look at our business in Europe and Asia, clearly our positioning is there. We have work to do in North America to elevate our positioning. I think as we continue to do that, I think the financial community will recognize that and will continue to see our valuation come closer to the historical luxury players.
Another top of the agenda issue here in Davos is generative AI and its explosion onto the scene. I know that you're thinking about it, experimenting with it. How do you think it's going to change the fashion business?
So this business started with human creativity. I don't think that goes away, and I reassure Ralph, and I tell him.
Let me show you guys something here really quick. Give me one quick second here.
By generative AI.
Mute this guy.
At the same time, we do see.
Just heads up here. Just be really careful. I'm going to go to the trigger screen here and let's see, webcam frame. Just on a 30-minute basis here on SPY. I want to draw your attention just here to this. See this maxed out hourly trend right here and half-hour trend. Whenever we hit stuff like this, we tend to roll to the downside over here. Just be wary of it. Whenever you see it, stuff like this, you'll get that grind and then that roll coming down. So just on a 1-minute basis here. Doesn't mean we can't go up from here. It does mean, though, that we are a little long in the tooth. We could possibly experience some kind of a roll coming up either today, tomorrow, something like that, at least on a 30-minute basis.
More, but this is Louvet's mission, is to bring Ralph Lauren as a competitor against the European luxury giants, the Richemonts, the LVMH, the Kerings, and to get a stock market valuation on par with that as well.
Right.
Yeah.
But you got to get margins on par with that too.
And he's done some work on it, but yeah, there's
a reason
more
Bernard
to be done.
Arnault is one of the richest men in the world, right?
Yes.
Those margins
He's done
are
that.
amazing at LVMH because I'm not sure the cost of manufacturing is that different.
No, and I think he has to continue to elevate the brand in places like North America, where, you know, outlets were a big part of the story for a while. And, you know, before he came in, it did go very mass market into the wholesale division. He's trying to work on that in an effort to boost margins.
Yeah.
AUR, it's called in retail.
The pure play luxury brands have that moat where they don't have to discount at all.
No.
Still to come this morning, have we hit peak oil? We'll find out what the CEO of Aramco is saying about that and oil demand when we return from a break.
Insurance.
Welcome back. I'm Pippa Stevens with your CNBC News Update. A judge postponed Donald Trump's defamation trial for at least one day. The former president was expected to testify today in the case, which will decide how much he will have to pay for defaming writer E. Jean Carroll. Both had already arrived at the courtroom when the judge put the trial on hold because a juror and two of Trump's lawyers weren't feeling well. Family members of hostages held by Hamas stormed an Israeli parliament session today after Prime Minister Benjamin Netanyahu told them there is no real proposal from Hamas for another hostage deal. An estimated 130 hostages are still being held in Gaza. And New Hampshire Democrats say voters in the state are receiving a robocall imitating President Biden's voice, telling them not to vote in Tuesday's primary election. The president actually won't be on the ballot because the Democratic National Committee mandates that South Carolina's primary is the first sanctioned contest of the 2024 nominating race. However, local supporters started a write-in campaign for the president. It's not yet clear how many people received the robocall. Sarah, back to you.
Pippa, thank you. Energy, a big topic for business leaders at the World Economic Forum in Davos this year amid growing geopolitical tensions, conflicts abroad. While I was there, I had the chance to sit down with the CEO of Aramco, the world's biggest integrated oil and gas company, to discuss, amid all of this push toward clean energy and renewables and EVs, whether we've hit peak oil. Listen.
Let's look at 2023, last year. People talked about peak oil even before that, but last year we were 102.5 million barrels. 2024, they're talking about another 1.5 million, 104.
So not yet.
2025, they're talking about another million barrels. So there is growth. But you see, at the same time, you see, if you go back 40, in the 90s or the 80s when I joined, 80% of the energy use was from fossil fuel. Today, it's 80%. But the scale is higher.
Wouldn't go there on peak oil. I also asked Nasser about global oil demand right now. Here's what he said.
If you look at the forecast, they're talking about 104. This is in the middle of economic headwinds. Still, we are not over what the economic situation we are in, but still, it's a healthy growth. If you think about it, even last year, we have grown by about 2.6 million barrels. So if you talk about 24 of a growth of 1.5 million barrels, that is significant. So there is a demand and there is a significant growth. And that's what we are seeing from our customers.
Healthy growth, significant demand. For the full conversation, you can tune in tonight for a CNBC Leaders special at 8 p.m. Eastern Time. And guys, he's been at the helm here for several years, including taking this company through the world's biggest IPO, which happened regionally, as opposed to some of the expectations leading up, got them through the attacks by the Houthi rebels, the drone attacks. I mean, we went through leadership, and because we had a long time to talk about it, you really got to have a window into not only his leadership, but how unique of a company this is. Remember, one that is, what, 98% owned by the Saudi government. He doesn't make the decisions on oil production, right, because they're the OPEC producer, but has made a lot of other really important decisions leading and guiding this company, including toward this future where they are having to diversify into chemicals, for instance, into renewable energy, and how he's thinking about doing that.
I mean, they're enormous in chemicals as well.
Huge. Yeah, I think he's done $95 billion worth of deals to bring Aramco more into chemicals and refining.
No, it's like sitting down, well, even more so, with Darren Woods or Mike Wirth. I mean, they're running an enormous company, one of the largest market caps in the world.
Right, but one with some interesting geopolitical considerations as well, because of the Saudi government, but also because of China. And they're very bullish on China, and they've tightened the relationship there with China and with some of the Chinese oil companies as well. So we talked a lot about that, what he's seeing both economically and geopolitically.
All right, let's...
Excited for everyone to watch.
Yeah, of course. What time?
8 p.m. Eastern tonight, CNBC.
All right, let's stick with energy here. Still, as you take a look, now we're going to join Sarah at 8 p.m. Still a top pick for many across Wall Street. That is overall energy stocks, despite what's been a kind of tough start to the year. Let's get over to Brian Sullivan and the CNBC team. They've been collecting all the names to watch here. And as you see, Brian joins us now with a bit of a breakdown. Good morning.
Hey, good morning, David and Sarah and everybody. All right, well, we're going to start with energy, but then I've got a little surprise for you guys at the end. We're going to show you all the stocks in any sector that are on 4 or 5 top picks lists of Wall Street firms for the year to give you a little investing edge. Quick note, this is taking a lot of time. A big shout out to our colleague Mike Bloom for helping me sort through literally mountains of emails over the past month. Could be a stock or two that we missed. This was a massive list, but we think this is a pretty good list. All right, so now to the names that are on Wall Street's top picks list. And since I cover energy here at CNBC, let us start with that sector. Makes sense, right? And all the stocks appearing on at least one top pick list for the year. And it's fair to say, guys, that energy is not overall well loved. There are only 23 different energy or energy-related stocks across more than 35 firms that we track on any kind of top picks list. All right, the first list is the more pure energy stocks, oil and gas companies. You got Exxon, Chevron, okay, we know that. You got Coterra, the original FANG, Diamondback, Civitas Energy. You got 2 Canadian names making the list, Suncor, Canadian Natural, also service firms, SLB, formerly Schlumberger, Halliburton, and Transocean, and wind companies as well. You got Solar, First Solar, and GE on the wind side. Now to some of the more energy-related stocks appearing on Wall Street analysts' favorite picks of the year. Some names like Air Products and Linde. You say, well, why are those on energy? Because they're both hydrogen plays. You got chemical companies, Huntsman and Methanex. Pentair, they help oil and gas firms push water through wells. Darling does biofuels. Energy storage company, Fluence, pops up. Wesco services utilities. Altus, a smaller cap renewable energy name. And even EV maker Rivian is on at least one top pick list this year. So, guys, there are the 23 energy or energy-related names most loved by Wall Street this year. But, you know, as I said, I'm not just tracking energy stocks here. In fact, there's a number of names. So here's what we did, guys. We went through, Carl, and we basically sorted all the stocks, and we found out how many are on multiple top picks or best bet type lists. Okay, for example, Exxon and Chevron, they're on 3 different firms' lists, but there are stocks showing up on 4, 5, or even more top picks list. We spent a lot of time breaking them out. Some of the names, only 14 stocks that are on 4 or 5 different firms' lists. Some names you think, some names you don't, guys. Apple, obvious. Bank of America, Citigroup, CSX. Look at D.R. Horton, Howmet Aerospace. That was a big surprise for us. They're on 4 different lists. You got JP Morgan Chase, Pinterest, Morgan Stanley, Nike, Salesforce, T-Mobile, Uber, and Wynn Resorts, all on 4 or 5 different favorites lists this year. And guys, tonight on Last Call, we're going to show you the stocks that are on 6 or more top picks lists. There are 6 of them, including the one stock most loved by more than 10 different firms on Wall Street. That's Last Call. It goes from 7 to 8. So here's what I suggest. Watch Last Call from 7 to 8 and then roll right in to Leaders with Amin Nasser. How does that sound?
I love that, Brian. It sounds like a perfect evening. What could be better?
Being at home.
Being at home. Watching you. Brian, thank you.
Thanks.
And then me. Brian Sullivan. For more on the energy picture and my conversation with the CEO of Aramco, be sure to tune in right after Last Call to CNBC Leaders, 8 p.m. Eastern Time. Don't go anywhere.
scale.
Got a couple of movers for you this morning, including shares of Archer Daniels Midland. See them right there, down over 13%. There were a number of downgrades. The company did issue fourth quarter guidance that seemed to be below many analysts' prior expectations. But the key reason why the stock is down is that it has placed its CFO on leave. This is amidst an investigation into accounting practices specific to its nutrition reporting segment, including as related to certain inter-segment transactions. Apparently, this was initiated after the SEC asked for a voluntary document request. They gave them the documents, they're cooperating, and whatever they saw at least warranted suspending their CFO. They have an interim CFO who stepped in. On the flip side of that, take a look at shares of Affirm. It's a company we follow, up over 9%, maybe just on rates, getting a little bit better this morning. Sarah, hard to know specifically what's behind that. But there have been a number of, whether it's Affirm, Upstart, Palantir, just in general, sort of some significant moves this morning amongst certain technology-related names.
Yeah, the ARK Innovation Fund is up 4%, so that's always a good benchmark of some of those less profitable or unprofitable tech names, which are rallying today. Let's talk housing. New home sales and pending home sales data out later this week, and with average mortgage rates now below 7%, buyer demand is coming back. However, our next guest warns of challenges ahead, such as, quote, the lock-in effect of current homeowners. Robert Refkin joins us, Compass co-founder and CEO. It's good to see you. Welcome.
Thank you for having us.
You were saying that things are looking a little bit different here as we go into 2024. How?
Yeah, well, it's official as of Friday. The number of homes that sold last year was 4.1 million. It was the lowest level since 1995. And the population today is 27% bigger than 1995. However, this year, all the key signs are pointing the right direction, specifically inventory, because more inventory equals more sales. And you have 7% more inventory today than this time a year ago. And you can see as well, 5% more homes under contract today than a year ago.
So is it that mortgage rates? Is it the relief? Is that what's changing things?
Yeah, 8.1% mortgage rates last fall was very difficult, but now it's basically free marketing to the entire real estate market saying that 6.8 is a good deal. And so you have more.
Is that working?
It is working. You have more buyers than sellers. And sellers today are more realistic on pricing than they were last fall. That modest buyer strike led to 39% of all homes in the fall having a price drop. And so prices are better now than they were.
The Redfin data on listings, new home listings, is up 2.7 year on year. You think that's low?
Yeah, I think that we're going to continue to see more demand for new homes than existing, because people today want things that are new, and there's just not enough homes available for sale in the existing home market because of the rate lock-in effect. This time last year, 72% of homeowners were locked in at 4% or below. Now it's actually 59%. And so, although it's still high, it's much better than it was a year ago.
Do people try to beat each other to the punch before spring comes? Or do we have to wait for spring like we in classic fashion?
In the last month, I've spoken to over 1,000 of our agents and just asked them, how's the market going? The most common quote I've heard is, this is the busiest January I've had on record, and more buyers are calling me over the holiday season than ever before. They were working over Christmas, they were working on New Year's Day, New Year's Eve. And so, yeah, I think buyers are trying to beat people to the punch before the spring market really hits.
Regionally, you always give us a breakdown. Does it continue to be some of these warmer places or low-tax states that benefit? And what about the pandemic darlings? Have they come back down to earth?
Yeah, the low-tax, warm weather states are still, excuse me, are still very attractive. But I think Florida has more staying power than some of those other markets. You know, Texas, Carolina is still strong, but Florida, it's just benefited longer than the others. It is a vacation community that the entire country can go to. So if you're, it is a retirement community. So if you're planning retirement 5 years from now, you could just accelerate it earlier. And there's still enough of the country that's working from home where it does make it more viable. I would also say the spillover migration markets. And so markets people move to when they're getting priced out of their core markets. So let's say San Francisco moving to Las Vegas or Sacramento. You have DC moving to Charlotte or Raleigh, or Austin moving to San Antonio.
6.8% is still a lot higher than, where are you? I mean, most Americans have under 4% rates, right?
Yes, 6.8% is still high, but that's encouraging for me to see that the market could be this strong with 6.8. Last year it wasn't this strong, 6.8, so it shows that demand has been building over the course of last year, and you can only hold back the market for so long.
Robert, thank you for the update. It's always good to get color from you. Robert Refkin from Compass.
Still ahead this morning, a look at the stock rout that's been hitting Chinese equities and erasing millions, much more than that in market cap. We'll head live to Beijing for the latest after the break. And an interview you don't want to miss next hour. The CEO of Marriott's with us. We'll get a read on the consumer when we continue.
Asset.com.
China is keeping its low prime rates unchanged as stocks continue to sell off. The Hang Seng approaching what is its lowest levels since 2009. The CSI 300, that's an index of mainland Chinese shares, that's also hitting multi-year lows. Eunice Yoon joins us. She has the latest from Beijing. Overall, sort of, the sentiment has got to not be particularly positive right now, Eunice.
Absolutely not, David. It is very pessimistic over here. Shanghai has hit a 5-year low. Investors are bailing out of Hong Kong as well, especially Chinese property plays. The central bank's decision was expected, but it's just feeding into the growing belief here that the government is not willing to make any meaningful stimulus or take any big action to try to shore up the economy. In fact, most of the speculation around the non-action by the central bank was that the authorities are much more concerned about the potential downward pressure that they could put on the renminbi. The authorities here are very sensitive about the possibility of the renminbi moving quickly, especially when it declines, because they're worried about the potential for capital flight. The traders had been talking today about how state banks appear to have been making moves to try to stabilize the yuan, in fact, shore it up by selling dollars. And there were also some reports in the market today that the regulator has been making unofficial guidance to some of the local funds to come up with new equity products in order to stabilize the market. The state media has also been weighing in with the Xinhua, which is the state news agency, has been saying that, really trying to debunk a narrative that we've been hearing, at least outside of China, that China, with all of its economic woes and its problems with its demographics, has hit peak China. And so Xinhua ran a piece today that said that it's an opportune time to pick China and not worry about peak China. Guys?
Eunice, I'm curious on the domestic front. I mean, it's been many years since I was there, but there was a great deal of interest amongst Chinese in investing. I remember this is years ago. They'd go into sort of almost parlors and buy stock and sell stock like it was horse racing. I don't know to what extent there is that kind of interest or enthusiasm, but what is sort of the mood and or the action on the ground amongst the domestic investors?
Well, the mood is not very optimistic. And in fact, I was talking to someone just yesterday about this, about where do you invest? And a lot of people here are really wondering where they can find any type of yield. The stock market doesn't look very good. Today, there was a lot of talk on the internet saying that, I've lost so much money. And that's the sentiment that I've been hearing just in conversations. Also, the property sector hasn't been doing well. So it's like home values going down. Where do you put your money? People have been talking about, where can they find investments overseas? But it's just gotten much more strict. And you could potentially be flagged if you take money out of the country. So it's a really, really difficult environment right now for average investors.
And I feel like we should separate both the near-term issues, Eunice, which you describe on the economy, the cyclical issues, and some longer-term structural issues. The number that stood out to me was that foreign direct investment actually went down last year for the first time in years. So it's not just investors that are worried about the economy, it's businesses worried about, big things like de-risking and geopolitical support. And I wonder how much of a long-term challenge that's going to be for China.
I think it's going to be a really big long-term problem. People have been discussing how they feel that the outlook for China just isn't very good when you look at all of those things, deflation, de-risking, demographics, debt, everything. So the outlook has been something that people are talking about, and one of the reasons why we're seeing all this money outflow from the Chinese markets.
Eunice, as always, appreciate your time and insights from Beijing. Thank you. Well, don't miss on the other side of this break. We're going to have Marriott's CEO and, of course, our live market coverage. That continues at all times. Back at this.
Good Monday morning. Welcome to Money Movers. I'm Carl Quintanilla. Sarah Eisen is back on the floor of the New York Stock Exchange. Today, the street debates the next move for stocks, with the S&P, Dow, and NASDAQ 100 all hitting some fresh all-time highs. We'll talk with HSBC's chief strategist on why he's cutting risk exposure.
Then more from our conversation with the CEO of Ralph Lauren, advantages and risks he's seeing from AI.
Marriott unveiling some new growth numbers with shares up 40% in the past year. Tony Capuano is with us live this hour.
Right now in the markets, as Carl said, new highs. We continue the strength building on last week's more than 1% rally in the S&P. It was fueled by big tech. Big tech is leading again today, although there are some bright sectors like real estate on top of the market right now. Energy is lagging. NASDAQ's up 0.2, so is the S&P. Dow also up a healthy 0.4%. Yields are backing off, so that's adding to some of the gains today, especially perhaps in some of the more speculative names, the unprofitable tech stocks that we're seeing big rallies in today, like an Affirm or a Palantir. Topping the tape for us this morning is those new highs in stocks. S&P, Dow, NASDAQ 100, all setting new records at the open. But how will a ramp in corporate earnings impact the rally? Bank of America points out that fewer companies are beating versus history, and beats not necessarily rewarded by investors, while misses certainly get punished. Let's bring in CNBC senior markets commentator Mike Santoli on the brink of a whole lot of earnings.
Yes, for sure. And that's a familiar pattern. You can actually go back 3 months and say that was exactly how the third quarter earnings season started. Really kind of harsh responses, low beat rate, at least in the initial phases. And then it was a tale of two earnings seasons, because you always get this sort of reducing of expectations. People get used to the negative reactions. And October 27th was the low in the market. It was basically when all the big tech stocks culminated their reports. Those few days. I don't think that's necessarily what we're looking at right here, because the field position of the market's very different. We were in a deep correction back then. And so now it's much more about, can we get some confidence that 2024 full year estimates are not pie in the sky?
Well, the other point that B of A makes with that guidance ratio is that January guidance tends not to be great anyway, because there's no reason to promise the world so early in the year.
No doubt about it. And really, the way the market has treated the fundamentals recently, it's much more about, look, we're trading at 19, 20 times earnings at the headline index level. It's clearly because you expect a handful of secular trends to keep working, and that we've seen the inflection point in earnings, and they're going to be moving in a positive direction, not just for a couple of quarters, but it's multiple years. It sounds ridiculous in January to say we got to have a couple of years of earnings growth, and at least that's what the market's looking ahead to. But I think that's where we are at the moment. Soft landing, I think, has been mostly embraced. You were talking, Sarah, earlier about how better economic numbers have not been toxic to at least the S&P 500, even though we're pushing out the potential for a first rate cut. We'll see. It's a bit of a delicate balance at this point. It's not clear to me that we've got the full reset below the surface that we were kind of expecting.
Right. I was looking at, so I was traveling last week and came back and looked at the charts and saw the melt up in stocks.
Sure.
But it was surprising somewhat that it came with a big, I would say, a jump in inflation expectations. You saw that in the tips, the 10-year tips market, in the fact that yields were a little bit elevated and rate cut expectations pared back.
Yeah, exactly. Well, I'm not surprised that necessarily higher stock prices coinciding with, maybe we have to wait for a first rate cut. Also, market yields are still in the manageable range. It seems like it was really just profit taking in treasuries, and we're still below 401. And so it's not necessarily forcing the issue as much as you might think.
Mike, we'll talk in a little bit. There's a lot to work with today. Mike Santoli sticking with the markets with the first Fed meeting of 24 set for next week. Our next guest says Wall Street is pricing in too much easing for the year ahead, predicting 3 cuts beginning in June and keeping a pretty broad scope when it comes to finding value. Joining us today, HSBC Chief Multi-Asset Strategist Max Kettner's back. Max, great to have you back.
Hello, thanks for having me.
Over the weekend, a lot of takes looking at real rates and UMISH inflation expectations for Friday. The argument being Fed's got a lot of room to cut if, in fact, expectations and the core data continues to roll in that way. Why June?
Yeah, look, I guess over the next couple of months, there's quite a few things that can go wrong, in the sense that not that we're suddenly going to see a recession or really the data really rolling over. I do think the danger is actually the exact opposite. What we have seen over the last 2-3 months, of course, is a record easing of financial conditions. We're probably talking about private household wealth in the US that has risen by around 13 trillion US dollars in 2023 on the back of that higher US equity market. So there's a lot of powder for the US consumer to spend. There's been a lot of easing of financial conditions. But the other thing that hasn't changed is that in Q1 and Q2, actually near-term growth expectations for both of those quarters are still very, very low from consensus. So that sets us up for a continued really low bar to beat in terms of activity surprises. And I think the danger is a bit comparable to what we've seen in the third quarter of last year, where expectations, again, have been very, very low, but the reality has been 5% GDP growth. And of course, with those sort of very, very dovish expectations that we've got right now, I would argue if we do get another sort of 3% plus quarter, that some of those dovish expectations really are a bit exaggerated, have to be pushed out. And then that's what we call reverse Goldilocks, where then higher yields really send a bit of pain across the asset classes.
It's getting reflected in a lot of media here in the States where supply has given us a lot. Maybe the next, you'd need to look to demand to help you out further. I am curious about your asset classes to avoid, including European equities. What is that all about? How much is centered around, for example, the dip in UK retail sales last week?
Yeah, I think overall in Europe, the absolute growth momentum, whether it's in the Eurozone or in the UK, really still remains quite sluggish. The advantage compared to 12 months ago is that growth expectations, both on the earnings side and on the top-down side, are no longer as optimistic as they've been 12 months ago, right? Remember 12 months ago, the consensus opinion was you've got to buy European equities because of the reopening in China and because the gas price crunch or the gas crunch has abated. That, of course, didn't work out at all. So consensus expectations did come down, fair enough, but the absolute growth momentum still remains quite sluggish. And one other thing that really should be weighing on European earnings going forward is the stronger sterling compared to 3-4 months ago, the stronger euro compared to the dollar, both of them. And of course, for export-sensitive markets like the UK and like the Eurozone, those stronger currencies in an environment of quite sluggish absolute growth momentum, that is toxic, right? So then really the rally that we've seen in Q4 in Europe is not really on sound footing, and we do expect a bit of a pullback there.
It really does feel, in terms of the outlook for global growth this year, that it's lumpy and that it's not connected. You know, there's this idea of coordinated growth, and it doesn't. Investors are pouring into Japan and the U.S., not so much Europe and China. And I do wonder how those opportunities shake out, and also how that sets up just global growth in particular this year.
Yeah, I think global growth, you're absolutely right. I think global growth, or the cycle really, is, like, to be quite honest, at least what I haven't seen before, right? We know that, for example, look at manufacturing. Even within manufacturing, there's these mini cycles going on. We know chemicals are really struggling. Autos are sort of trying to get out of the doldrums, whereas, construction, particularly with you guys in the US, is on fire. So even those businesses or industries within a tiny sector like manufacturing are having these very independent stages of the cycle at the moment. What I would say, how you have to position right now, if we do get a bit of a reverse Goldilocks going, where particularly US growth, which at the end of the day is the most, that is the most important, that is going to be the key factor, the key determinant. If we do indeed surprise very, very strongly to the upside in the next couple of months on the activity data, that it's particularly short duration assets, right? It's things like short duration or short dated IG credit. It is, you mentioned Japan, Japanese equities are very heavily correlated to higher treasury yield, to the stronger dollar as well. So those ones really are quite good to go for. LATAM equities as well. And in general, just a stronger dollar as well, particularly against some of the European risk currencies.
Indeed, and we'll watch. We're going to watch China very closely over the next few days for sure, Max. Good insight on a host of topics. Appreciate it very much.
Thank you.
Up next, the CEO of Ralph Lauren on the impact of AI on the fashion industry. More from our conversation in Davos.
Plus, keeping an eye on Tesla today. Morgan Stanley cuts its target on the name. They go from 380 to 345. They note that global EV momentum, in their words, is stalling and that the market may be oversupplied, off more than 15% in the past month.
Welcome back. Let's talk retail. How do luxury apparel brands differentiate themselves in an increasingly crowded retail environment? That was one of the many themes that dominated discussions at Davos last week with business leaders. I sat down with the CEO of Ralph Lauren, Patrice Louvet, for an interview to talk about this as well as his outlook for 2024 and how endorsements and ad spend will define the winners and losers of retail for consumers this year.
One of the challenges in this industry is if you chase trends, that might be very effective for 3 or 4 years, and there you've seen some incredible companies kind of do that very well and then fall off a cliff, because then the consumer really doesn't know exactly who you are anymore and what you stand for. So for us, while we do want to be fresh and relevant, we're also it's very important for us to stay consistent with what we stand for, what's our points of view, what's our philosophy, and AI can't help you with that.
Is there any concerns developing around copyright or intellectual property theft, or what goes into some of these models?
I think that's a real question. Absolutely. For example, we have 57 years of design history. We actually have it captured in a library in New York City, where we've kind of cataloged everything that's been created over the past 57 years. That's gold for this company, right? It's really the foundation of this company. We want to make sure that's protected. So that is a real issue, as it is across many industries, as we're talking here this week.
Feels like that's going to be a battleground.
IP. That's true. That's true in media as well, right? I think it's a very important battleground.
Yeah, I mean, it would be nice to see some sort of regulation or arrangement.
Yeah. We have to codify it. I think we have, and there's clear will to do that, and there's an absolute need to do that.
You're in the restaurant business as well.
We are in the restaurant business.
Is that about branding or growth or
That's about consumer engagement. So we have 5 restaurants around the world. We just opened one in Chengdu, doing very well, Ralph's Bar. We have 25 coffee shops around the world. It's about giving consumers around the world an opportunity to discover and enter the world of Ralph Lauren differently than if they were going to do it through apparel. So, fun fact, we touch 2 million people every year with our hospitality propositions. So a wonderful way to present the brands to consumers who actually discover us through a cup of coffee in Shanghai.
And then they go buy a sweater?
And then we trade them up, or we trade them across the portfolio. We just launched preparation for the Olympics in Paris this summer. And as you know, we sponsored the US team coffee shop in Paris. And it's been a month, after a wonderful start. So the consumer, wherever we put it, whether that's in China, in Japan, in London, in New York, we're getting incredible response. And I think we're getting incredible response, not that we want to be in the coffee business, but we want to be able to invite consumers into the Ralph Lauren world, and this is an effective way to do it.
Speaking of consumer engagement, Taylor Swift wore Ralph Lauren on the cover of Time. Beyonce wore Ralph Lauren on the Renaissance tour. J-Lo, the wedding, she's worn Ralph Lauren. Does this give you a material long-term boost? And did you initiate those relationships? Did you pay for them?
Right. So it is part of our marketing portfolio, and as something you know, we've increased our marketing spending significantly over the past 4 or 5 years, more than doubled it. That ranges from fashion shows to sporting events to gaming, to partnerships with celebrities. They are friends of the brand, right? Because we're very wary, Ralph and I, of seeing individuals kind of move from one brand to another driven by paychecks. And whether that's J-Lo, Beyonce, J-Lo reached out to Ralph for her wedding. And Ben was also dressed in Ralph Lauren.
Oh, I didn't know that.
Beyonce reached out. I was with Ralph.
I cared more about the dress.
Yes, well, I look at both. Beyonce reached out to Ralph for her Renaissance tour. I actually was with him in Colorado last summer when the conversation had started. And then we were super excited to see that Taylor Swift decided to wear Ralph Lauren for the cover of Time magazine.
Not bad, Taylor Swift, Beyonce, and J-Lo. You can find the full interview on the Money Movers podcast. You can subscribe wherever you get your podcast. Fascinating sort of conversation about everything from the global economy to AI. And I think what you got there is a taste of the sort of opportunities in terms of productivity and enhancing designers' ability to use AI, but then the copyright issues. We know, for instance, the New York Times is suing ChatGPT owner OpenAI. I mean, that transcends to the fashion world as well, and protecting what he says, their library that they have physically in New York of all the designs Ralph has ever made. They have to be able to protect that, both financially and sort of as a way to control the brand.
Yeah, journalists wonder how they're going to get paid for all of their work, and designers feel the same way. The strength on China. is interesting. Richemont, Hong Kong, China was up 25. How do we square that with everything we've just been talking about the last 2 hours?
Strong brands are doing well in China because it's not exactly, I mean, Burberry had a weak quarter in China and some of the other consumer companies as well. No, he said that China continues to be strong. Also for Ralph Lauren, they're coming from a pretty low base in terms of they're seeing growth because it hasn't been in the Chinese market, for instance, in a big way. But what you saw from Nike as well, that China's growing, not as fast as it once was. I think that it's not booming necessarily, but for brands that are strong and that have invested a lot and are still growing in China, like a Ralph Lauren, he's very bullish on it. I additionally spoke to a number of business leaders, including Aramco CEO Amin Nasser, as we discussed how, for instance, one thing, the Red Sea disruptions are affecting the global oil market right now. Here's what he says about this.
We do have
an alternative route.
Alternative routes, while others don't have an alternative routes to bring their barrels to through the Red Sea.
I saw Qatar had to reroute a gas tanker.
Yeah. Unless you have pipelines, for example, we do have, as I said, pipeline that will to meet our requirement. However, there is certain products that will be impacted, but we do have ways of managing that. That goes through.
Just keep your eyes on this. Find out if there's a rejection or not here on this 5-minute trigger. If we don't reject, we should continue back to the upside. We are bouncing off the half hour right
as a
now.
whole, how disruptive is it?
It is disruptive in a way if it continues for it increasing the burden on having available tankers, because when you take 2 to 3 weeks more to deliver, the tanker is booked for a longer time and there's not enough tankers. So even containers, shipping containers and all of that. So if it extends for a longer period of time, it will have an impact on supply chain. Because you should not look only at oil and gas. There is materials, spare parts, equipment, goods that comes from there. That will have an impact. So if it put a lot of burdens on the companies and the industries, because they have to pay higher cost. It will take, as I said, longer. Insurance prices goes up. So a lot of implication for the industry.
You can watch my full conversation with Nasser at 8 p.m. Eastern tonight. It's part of our CNBC Leaders series from Davos, airing all week long. And I chose to play that part for you, Carl, because I know it's top of mind right now for investors as these Houthi rebel attacks continue out of Yemen, backed by Iran, and it disrupts global shipping, including the oil trade. Interesting. He says they're not affected. They have an alternative route, but the longer it lasts, it's obviously disruptive.
Yeah, the bear argument is that there is new capacity coming online this year, but it's not tomorrow. It's going to be a while, and what happens in the short term is going to be important.
You mean capacity for energy?
New freight capacity, new shipping capacity that would still go around the corner, but would be more boats.
More expensive, too, I think, is the question, and at least in the short term, until they can get there.
Fascinating. What a point of view on such an important story. Later on this hour, the CEO of Marriott's going to reveal some new growth numbers. Stocks up 40% in the last year.
And just mention the energy sector. Natural gas on pace for its 5th down session in the past 6 this morning. Right now, falling more than almost 5.5%. We're back in 2 minutes.
So in 5 minutes' time now, at the bottom of the hour, the US is due to sell $77 billion in 3-month bills, with a prior high yield of 5.225% and a prior bid to cover of 2.99. The US is also due to sell $70 billion in 6-month bills, with a prior high yield of 4.975% and a prior bid to cover.
European markets moving higher this morning as investors await the ECB rate decision later this week. About 100 basis points of cuts have been priced in for this year, with 96% expecting the first cut to come in June, according to Reuters. But our focus this morning turns to China, with Beijing setting a 5% growth target for 2024. They officially did that, higher than last year's target, despite lower growth expectations. And then state-owned CCTV reporting that the country will aim to, quote, consolidate and strengthen the upward trend of the economic recovery and promote stable and healthy development of the capital market. Markets not so confident for the time being, though, with the Hang Seng in Hong Kong, lowest level since 2009. The Shanghai Composite posting its biggest one-day drop since April 2022. However, other Asian markets are outperforming. The Japanese Nikkei has been on a tear, a 34-year high. One business leader bullish on Beijing this year is NVIDIA's Jensen Huang, trading in his iconic leather jacket for traditional Chinese garb, as you can see, as he visits the country. Of course, that video getting a lot of attention. We know that NVIDIA has been trying to sort of get around the export controls and make new chips for the Chinese market because it's an important customer. And that's been a big kind of question for investors after the last earnings.
Yeah, 120 plus stocks in China limit down today versus 38 on Friday. B of A is hosting a China capitulation call tonight. So we'll see if there's any kind of relief coming in the days to come.
Because going into the year ahead, it was like, this is the cheap market, right? There's a lot of value here, but so far hasn't really panned out. And the Chinese have had to intervene in the currency market to try to prop up the yuan. They're dealing with risks of capital flight.
Yep. The ABC rotation anywhere but China,
yes,
as B of A says. Meanwhile, a couple hours into trading here, Dow's up 150. Let's get to Bob Pisani. Hey, Bob.
You know, guys, the Shanghai and Shenzhen markets, the two big global markets that trade China A shares, they've gone nowhere for 17 years, since 2007, essentially. We'll talk more about that on ETF Edge coming up the next hour or so. But I want to just note we're at new highs, of course, on the S&P 500. How we got here was largely technology. Again, today you see Microsoft, NVIDIA, new highs, Alphabet, Meta at new highs. Let me just show you this screen here, because the advance since 2022, the new high that we passed, was mostly due to technology, 15% move in technology. Energy was the biggest mover, but remember, energy is only 4% of the S&P. Technology is about a quarter of the S&P 500. Industrials also had a modest contribution as well. So in addition to the biggest big cap stuff, we've been pointing out the momentum in some of the really big cap software names. So again, here's your stalwart. I've seen to put this up almost on a daily basis as we had Salesforce hitting another new high. That's, of course, a Dow component. There's other big software as a service, mega cap names that have been hitting new historic highs as well. Bill McDermott says ServiceNow, stalwart on CNBC every single day now, hitting new highs. Not a lot of momentum elsewhere. One subgroup not paid a lot of attention to is insurance stocks, which on the back of Travelers, fantastic earnings last week, where the pricing was much higher. We're all paying more for insurance, folks. That's another new high for Travelers today. So there's your momentum there in technology and insurance stocks. Elsewhere, I keep waiting for oil stocks to bounce. I mean, it's true, oil's just stuck at $73 for ages and ages. But these exploration production names like EOG, down 9% on the month. No energy, not a pun, folks, no desire to own them at all. And it's not just EOG, Marathon, Conoco, Chevron, really not going anywhere. It's kind of a major problem for the markets here. I'd like to see some movement. A little bit of excitement on the IPO front. Remember, we got new highs on the market. Some hope the IPO market will start opening up. We did have an announcement today of an interesting IPO that's coming. Amherst Sports is going to be here at the NYSE. It's scheduled, and this is not permanent, it's scheduled for next Thursday here at the New York Stock Exchange. This is one of the big international sports brands. They won Wilson Sporting Goods. And it's going to be a fairly big deal. They just announced some of the terms here. Looks like $16 to $18, 100 million shares. That's $1.7 billion. IPO, Sarah, and could be, depending on where they go, about an $8 billion overall market cap. This will be one of the first significant IPOs since Birkenstock, believe it or not. Remember that, Sarah? It was way back in October. So finally, a little bit of excitement. And let's see, there's a lot of names. I got a Trader Talk this morning out, folks, if you want to look, tradertalk.cnbc.com, listing some of the other potential hopefuls out there. A long list, Sarah, as you well know. Back to you.
Yeah, I can see why the market would be opening. I mean, rates have stabilized, but I'm just looking at Birkenstock. It's like $2 above its IPO price and had a really ugly reaction to earnings last week. So that could give
the IPO ETF is down 8% this month, with the markets at a new high. So it's you know, they're all hopeful it's going to happen, and we've been hopeful for 2 years that things are going to really start moving, and it's just been a really rough time. The valuation haircuts last year killed a lot of these companies that are out there. That's why companies like, you know, Reddit and everybody else is sitting out there waiting and waiting and waiting. So let's see if we can finally get things going here with the markets at new highs.
Maybe this will be the year. Bob, thank you.
All right.
Bob Bassani. Time now for a news update. Pippa Stevens has that for us. Hi, Pippa.
Hey, Sarah. The president is convening key members of his cabinet today to discuss abortion rights on what would have been the 51st anniversary of the Roe v. Wade ruling. This is the fourth meeting of the task force since the Supreme Court overruled the landmark abortion rights ruling. It comes as the Biden administration announced new efforts to expand access to contraception, as well as a push to require hospitals to perform emergency abortions nationwide. Hundreds of people were evacuated from a remote village in southwestern China today following a landslide. Rescuers are now working to find survivors in the roughly 18 homes buried by the landslide. So far, 9 people are confirmed dead. Crews are working against freezing temperatures and snow that are forecasted to stick around for the next 3 days. And more than a month after he ended his GOP presidential nomination bid, North Dakota Governor Doug Burgum said he will not seek a third term in state office. Burgum, a wealthy software entrepreneur, dropped out of the race in December and recently endorsed Donald Trump. Carl, back to you.
Pippa, thanks. Regional bank earnings continue this week. The CEO of Banco ZKs joins us next, outperforming the KRE by 25% in the last year.
Plus, we're watching Boeing. The FAA now recommending the inspection of other models of 737 MAX planes. Shares are lower again, about 0.6%. You can read more about that one, CNBC.com. Stay with us.
Welcome back. Let's dig into some regional bank earnings. Take a look at Bank OZK. Q4 results did beat estimates, sent shares higher last week. Both loans and deposits up nearly 30% year on year. Joining us in a CNBC exclusive this morning, Bank of OZK CEO George Gleason oversees roughly 250 locations, largely across the south central U.S. George, it's great to have you with us. Thanks for the time today.
Thank you, Carl. It's nice to be here. Thank you.
A lot of discussion last few days about whether the regionals are sort of back in the loan business. It sounds like you think growth is going to be fairly linear this year.
Carl, we never left the loan business. The events that created so many headlines in March and April of last year, obviously showed a few banks that were very unprepared for the interest rate environment, the economic environment they found themselves in. On the other hand, we were very well prepared, and we had a great year last year, record year in net income up 23%, record income and earnings per share up 29%. So we continued business as usual all year long. And we had loan growth and deposit growth last year when many in the industry did not have growth. Our loans and deposits grew over 27% each for the year. So it was business as usual for us. The turmoil in the industry and the fact that a lot of banks were shrinking their balance sheets created a lot of opportunities for us to gain market share and gain customers. And we were in an extremely good position to capitalize on those opportunities.
Interesting. So how would you describe, to the degree you're cautious about elements like construction or CRE loans, how cautious are you?
Well, we are probably the largest construction and development lender in the country. We're in every major market all the time. And certainly commercial real estate is a part of the economy that's facing a lot of challenges just because of higher interest rates. But CRE and CRE lenders are very different, and different members of the capital stack have very different positions. We're in every market in the country and every product type. So we see that market really well. And certainly it's a challenging environment for equity because of rising costs to produce their projects and higher cap rates, higher interest rates, and softening demand for rentals in some markets on some product types and for sales on some product types. If you're in equity, it's been really challenging. If you're somewhere else in the cap stack that's, equity-like, it's very challenging. We are a super low leverage lender. Our average loan to cost on the projects we finance is about 53%, and our average loan to appraised value is about 43%. And that significant amount of equity, real dollars, equity around 47% on average, and on appraised value about 57% equity on appraised value, gives us a significant cushion. So we're able to continue to very actively engage with the market and serve our customers even in this environment. We never leave commercial real estate.
It makes you unique because you're growing these CRE loans in this environment and not seeing the kind of stress that we're seeing at the bigger banks on commercial real estate and office in particular. George, I'm curious if you could just broaden out for us, just in the major metro areas that you serve, what you're seeing on a macro level from businesses and consumers. Are trends improving? Are they cooling off? What are you seeing? What's the outlook?
I would say trends are challenging, Sarah, and it very much depends, at the macro level on what sort of economic environment you're in. As I mentioned, we're in markets all over the United States. So if you're in Florida or Texas, you've got economic tailwinds, demand tailwinds, because those markets are growing. If you're in markets that are shrinking and having, an outflow of businesses, particularly because it's not a favorable business environment, those markets are much more challenged. Commercial real estate is very much an asset by asset basis. You can generalize about it, but you get in trouble if you generalize. It's not just states, it's not just cities, it gets down to submarkets and even macro markets within those cities. A new building 2 blocks from a 25-year-old building, it may have an incredibly different profile for leasing and functionality.
Yeah, it is extraordinarily complex. We keep trying to remind viewers how many different slices you can take on CRE. George, it's a great lens to understand a complex topic. Thank you. Good to see you.
Thank you.
Thanks, George. Marriott's Tony Capuano is with us after the break. Record year for expansion and room growth. Company just updating numbers this morning. Stocks up 40% in the past 12 months. Don't go anywhere.
Crash courses.
Welcome back. This morning, Marriott announcing a record year of global signings with 52% more organic rooms signed in 2023 from last year. Marriott also highlighting strong net rooms growth of 4.7% last year. Joining us now to help make sense of these numbers and what he's seeing from the America's Lodging Investment Summit in LA, Marriott CEO Tony Capuano. Tony, it's great to have you. Welcome.
Hi, Sarah. Thanks for having me.
So put these numbers, if you could, in perspective for us. I think this is a higher rate of rooms added than you had originally forecast last quarter. What sort of growth does it represent for you going into this year?
Yeah, so the openings, the 4.7% net unit growth is a little higher than what we had guided and a little higher than consensus, which is terrific, and it actually excludes the impact of the MGM transaction. We expect those rooms to come in sometime early this year. What's just as exciting to me is the signings volume, as you pointed out in the open. Our organic room signings last year were up 52% year over year. We hit an all-time record. We signed 164,000 new rooms, and that excludes the impact of the City Express acquisition we did last year, which added another 17,500 rooms. So really strong growth momentum last year.
What does it speak to, Tony? Because I thought for a while there was kind of an inventory problem on hotels, as banks were slow to lend, and it was just harder to build hotels and get them up and running, harder for smaller hotels out there. So what does this speak to? What kind of environment?
Well, it speaks to the continued resilience of travel. It speaks to the confidence in the owner and franchise community. And a year ago, I think there was some trepidation, particularly because of some of the constriction in the debt markets here at home and in Europe. But it's one of the reasons that conversions have become so important. And in the numbers that you shared, about 25% of our openings last year were conversions, and actually 40% of our signings came through conversions. And I think as we look into 24, conversions will continue to be a really important part of our growth story going forward.
So now will you be able to keep the demand? Will we see the kind of demand that we've seen in 2023 to fill those rooms?
Yeah, so as you know, we saw about 9% RevPAR growth in the third quarter. We'll announce fourth quarter earnings right after Super Bowl, and Leeny and I are really excited to share those numbers. But the growth patterns that we're seeing are really encouraging. Group continues to be really strong. We're not really seeing any slowdown in leisure, and we continue to see slow and steady improvement in business transient. So we're quite optimistic about continued demand growth.
Tony, the Street's taking a sharper view of airlines recently. Now, there's a lot folded in there. There's oil prices, there's some capacity issues. Obviously, mergers aren't going that smoothly on antitrust, but do you think that has any impact on how the Street's viewing lodging?
Yeah, it's a good question, Carl. My guess is they're looking at the experience we saw in the early days of recovery from the pandemic, when travelers perhaps were a little nervous about flying. We saw a big uptick in the performance of drive-to destinations. And so even if there is some sense of weakness in the airline sector, they know how well historically our drive-to destinations have performed.
Does it feel to you like the spring and summer are going to be about domestic travel, or are we counting on continued strength in transatlantic and maybe some budding progress in Trans-Pacific?
Yeah, it's a little early to say, although some of the early things I hear from our Caribbean team, the spring break numbers are really encouraging. When you talk to our European team, I think they're pretty optimistic that we'll see another really strong group of numbers with transatlantic travel into Western European destinations. And when you talk about Trans-Pacific, China looks really encouraging. The question will be whether they continue to see strong cross-border travel. A lot of the recovery that we've seen over the last couple quarters has largely been on the shoulders of domestic recovery. Remains to be seen whether we see continued recovery in cross-border. And a lot of that will hinge on whether we see a return of those cross-border airline seats. At the end of last year, we'd only seen about 60% of the international airlift into China recover to pre-pandemic levels.
Tony, I'm wondering what's happening on the jobs front. You guys have been the jobs creator over the last year and a half, obviously the biggest jobs loser during the pandemic. Have you hired back everyone you need to, and what does that look like going forward?
Yeah, we're never really at full employment. I can tell you in our biggest market here in the US and Canada, essentially we're back to about where we were pre-pandemic. Prior to the start of the pandemic, we were at a steady run rate of plus or minus 5,000 job openings at any one time, and that's about where we are today. So we feel like we're essentially that we're back to pre-pandemic employment levels.
And really quickly, what's the hottest part of the market? Is it luxury in terms of pricing and the segment?
Yeah, it's a good question. I'm not sure it's a binary question. Luxury continues to show great strength, but just last week I was in Fort Myers, Florida for the groundbreaking of the first Studio Res, which is our entry into mid-scale extended stay. And we're seeing extraordinarily strong demand in the mid-scale tier as well. So I think we're seeing strength in demand really across sectors and across price points.
Tony, thanks for joining us with a snapshot of the business, especially on those new numbers, helping investors
Thanks
understand
for having me.
Tony Capiano from
Good to see
LA.
you both.
You too.
When we come back, is there still room to run this year for tech? We'll look back to 1999 for some answers when Money Movers is back in 2. Big tech shaking off a rocky start to the year. NDX hits a new all-time high Friday and it's causing some to compare it to the tech-led stock market party of 1999. Our Deirdre Bosa is digging into that for today's Tech Check. Morning, Dee.
Good morning. We've heard that before. We're probably going to hear it again. But so far, at least, this moment of AI mania and tech's rally, it has nothing on the dot-com bubble. But it doesn't mean that Wall Street isn't getting a little nervous. A note from strategist Ed Yardeni, it's making the rounds, warns that potential Fed easing risks fueling irrational exuberance. He even asks, is NVIDIA as today's Cisco, noting that it's, quote, starting to remind us of the parabolic ascent of Cisco stock during the tech bubble of the 1990s. So let's break that down. NVIDIA would have a lot further to run before any kind of crash, which he does acknowledge. Back in 1999, Cisco had a price-to-earnings ratio of nearly 150. NVIDIA's is currently 80, but its forward PE based on expected earnings in the next fiscal year, that's 50. Cisco's growth outlook back then was just 30% versus NVIDIA's expected growth this year at 119%, nearly 60% next year. So yes, NVIDIA shares, and we made this point before, they have more than tripled last year, but that actually lagged the fundamental growth of the business. Earnings nearly quadrupled. Now, the question of irrational exuberance, however, may be more relevant in other areas of tech, like software sector, whose rally has been fueled arguably less by AI, more by the prospect of Fed rate cuts. And that is looking a little frothier. The software ETF, the IGV, that's up 25% over the last 3 months, and it's outperformed the broader NASDAQ this year. So while investors, they typically pay for growth and future profitability in these software names, growth estimates have come way down as well. Rate cuts, that could make those valuations look better, but it's unlikely to help the fundamentals, especially if AI spending accrues to new names, not yet public, or the mega caps. Lastly, guys, no sector has done better than semis this year. On that note, I leave you with Jensen Huang dancing in China. I know you showed it earlier, but I can't get enough of it. Counterpoint, though, let me just show you an AMD stock because I saw this as I was coming to air. Those shares are down 3.5%, kind of an outlier in the semi space today. And that's on a note that said that AI spending may not be that big. It's going to be big, but not that big. And it's a good reminder of what happens at these high expectations and if these companies, especially the semis, don't meet them.
Yeah, the Yardeni note that you mentioned is pretty interesting. He's not giving it full probability. I think he's at the 20% probability, but he does say, Dee, that the forward PE of tech back in the 99 went to 50. We're at about 26 right now.
In a way, you could read that note as very bullish, right? Because that is a lot of room for the markets to run. But, you know, a lot of the participants, they're looking at what are the catalysts this year. There's generative AI, yes, but are we going to see more applications, especially with the Vision Pro coming out? And IPOs, right? Still an open question, guys. Which companies are going to go public? A trend that we've been following on Tech Check is private companies staying private, especially some of the most exciting ones, and doing stock buybacks, letting employees cash out. So that's still a big open question, whether we see it.
All right, Deirdre, thank you. Deirdre Bosa. As we head out, Carl, looks like we're holding the gains on the S&P, Dow, and NASDAQ. We're record highs, building on Friday's record close for the S&P, adding to gains. Tech is leading, although it's pretty broad today in terms of sectors. Real estate, for instance, at the top of the market. We've got a lot this week on data. We have GDP, first look at the fourth quarter. We have PCE at the end of the week. A ton of earnings. The New Hampshire primary, you know, I'm seeing more and more in the research notes how after Iowa, Trump presidency, for instance, might impact the markets. Usually, I think the old adage is investors kind of discount politics. They don't pay close attention to it, but that didn't happen in the last two elections.
Starting to draw some assumptions on the dollar and the peso and a bunch of other things. We'll see what happens in New Hampshire tomorrow. Let's get to the judge.
All right, Carl, thanks so much. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour. Stocks extending their record highs with some big names once again on the move. We'll discuss and debate how to play the rally with the investment committee. Joining me for the hour today, everybody here at Post 9. Joe Terranova, Anastasia Amoroso, Jason Snipe, Jim Lebenthal. Let's take you to the markets. We are in the green across the board. Dow tops 38,000.
Sorry about that. I'm watching
you say this is the
something
moment
about
of truth
Discord
for the rotation argument, because what looked like it was going to have some staying power at the end of 23 hasn't really worked out that well so far in 24.
That's exactly right, Scott. You know, and let me start by saying, all right, we're at an all-time high, but I don't feel anybody, including myself, that's going to do a Jason Kelsey here and rip off their shirt to celebrate their brother's touchdown. It just doesn't feel that way. Now, why is that? Why is that is because the equal weight, the small caps, have not participated year to date. So, yes, you've got a new high, but it's the same Mag 7 that's leading the way. In order for that to broaden out, this is the moment of truth. Earnings need to prove that the broadening of the rally is deserved. The broadening of the rally is not going to happen on rate cuts and the debate whether it's 6, 5, 4, or 3. That's not what's going to broaden the rally. Earnings are going to broaden the rally. And if you don't get them, then this new high feels a lot like winning a football game because your opponent missed a last-minute field goal wide right.
If you happen to be overexposed to cyclical names, it feels like that. If you dance with Ubranya, and you're in these.
No, I'm meeting with attorneys this morning, and then I'm working on Discord. We got to
on the year.
Hold on. We got to do a roll.
Right. Well, so far you look at the market performance.
So I'm trying
and you say,
right
well,
now.
There's no
Let me
need to
mute this here.
rotate. You're right back to the playbook of 2023. But I am with.
So I have to work. So we're supposed to be launching on the 31st, and when you have a free Discord, you attract scammers, bots, all kinds of stuff like that. So we have to do a roll into a new Discord that basically wipes all those scammers out. So I'm looking for, I have to do an oath thing and all this other kind of stuff and have it ready to rock, more ready to go.
And Scott, what I say is the bar is set low for earnings across the board outside of financials. For example, typically you do cut back earnings estimates by about 3 or 4 percentage points leading up to the start of the quarter. This time we cut them back by 6.8%. So I think the bar is low. And in the next couple of weeks, we've got communication services, consumer discretionary tech sectors that will be reporting, and they're not reporting a negative 18% earnings decline like we see for financials, but a positive 18 or in some cases 41%.
We stay with this idea that we're going to get this rotation, or at what point do we abandon ship on that?
It's an important question to ask. I think a couple points that were already made in terms of the beat rate. So the beat rate, earnings haven't been great. There's only been a 62% beat rate. The average is 77%. We do need the other 493 companies of the S&P to participate and really start to grow. Semis are up 7%, right, and year to date. A lot of that is on the back of some of the Taiwan Semi guide and report.
That's
so
right.
For me, yes, we going forward, we have 15% of the S&P to report this week. We'll see how that develops, but we absolutely need to see broader participation.
I mean, you've been looking at this from the beginning of the year, wondering if all of this talk about broadening is just talk and it's not going to actually happen.
Okay, so compare S&P value versus S&P growth on earnings expectations. S&P value doesn't see double-digit year-on-year revenue growth until the end of 2024 at best. S&P growth, double-digit growth is there. It's evident. And in fact, that double-digit growth goes into the 20 to 25 to 30% range. So that's where the clear growth is. I think really what shook that narrative was the backup in yields. The backup in yields drove a lot of capital back into the quality factor, drove capital back towards the mega caps. And you would have to see, I think, a reversal. You would have to see yields return, in particular the 10-year. You've got to get that 10-year back down to about 3 3/4 to ignite some of the Q4 type of price action.
Well, see, that's why, Jan Hatzius over at Goldman says first cut, to your point, is happening in March. David Kostin there says lower rates are going to just continue to fuel this appetite for growth stocks.
Yeah, I think they are. And the point that David actually specifically makes that it's not just growth stocks, but stocks can continue to grow in terms of their return on equity and can continue to grow into their profitability. When you are in an environment where you're uncertain where the economy is headed, you go to where the highest profit margins are. And when you have this perceived safety of margins, and that's got why people flock to the Magnificent Seven. But now, if you think we might have Fed easing on the table, then you start going to stocks that may have higher leverage, have lower growth today, but higher expected growth in the future. So that's David's point. I'm sympathetic to that. And we've been looking at the Goldman Sachs Unprofitable Tech Basket, which so far is down 15% for the year. But I think at some point that catch-up trade is going to start working again.
Apple remains the place to look. So 3 downgrades in the last 2-3 weeks.
Yes.
Do you remember, prior to this string of downgrades, a few months ago, Apple got downgraded, and we joked on the show, like, okay, that marked the near-term bottom for that one.
Yes.
And then, Apple comes roaring back off of that downgrade. And then it gets these 3 downgrades, and stock's looking dicey. Technically, it's kind of messed up. The last one was Redburn Atlantic downgrading it to neutral. What happens from there? Stock's pushing back towards 200.
Mark the bottom once again. It's remarkable because if you look at the S&P 500 year to date, which I did this morning, 71% of the S&P 500 is underperforming the overall performance year to date for the S&P. And going beyond that, actually 61% of the stocks in the S&P 500 coming into this morning were actually negative on the year. So you take a stock like Apple and you try to insert this negative sentiment towards it in the face of very, very strong fundamentals. And strong fundamentals, not just from the standpoint of earnings, which have been relatively flat, but just the ability to buy back their own stock. And what's interesting about the rally over the last several days is, remember, it's happening at a time where we're in a blackout period for corporations to buy back their stock, which is another compelling case. But I think Apple is just a classic example of not trying to push against the overall momentum in the market. And the momentum in the market is incredibly strong. And the momentum in the market is being captured by a lot of non-discretionary funds. And I really want to highlight that because I don't think people understand how the market structure has changed so dramatically to where now you have algorithms, you have quant funds, and you have non-discretionary capital that really is the overwhelming driver of where the market goes. And I think Apple is a clear example of being a beneficiary of that type of non-discretionary momentum.
You could make the argument, Jason, that, you know, the time to be negative Apple was when it was going to head down into the 160s, like the high 160s. Is where it got back to. Now it's rallying back once again, and we have the parade of downgrades in the last couple of weeks. Today, not so much. Bernstein reiterates it as market perform. Bank of America says AI could drive Apple to outperform in 2024. Stronger upgrade cycle coming, driven by the need for the latest hardware to enable generative AI features. So that's their call there.
Yeah, so I think for me, I mean, you pointed it out, Scott. I mean, three downgrades, right? And then you see obviously the price action that we saw.
It's rare that you see one downgrade, okay? In the span of a week, or 8 days, from January 2nd to January 10th, you got 3.
100%, and then they lose the position as the largest company in the world, right? And then Microsoft obviously takes the lead, which obviously Microsoft's price action has been strong. But again, I think for me, as it relates to Apple, you know, a couple weeks ago it was a source of funds. You know, you get the upgrade, and you know there's no longer concern about the multiple 29 times forward. Foxconn is no longer issue supply chains upgrade cycle. We hear about the glasses, 180,000 pre-orders sold, right? So I think it's just benefiting from the momentum in the tech space as rates pull back.
You got the watch drama. You have some potential regulatory issues, DOJ, all these reports coming out. It's like, okay, the stock doesn't seem to pay much attention to it over the last, you know, several days, looking ahead probably to earnings and figuring that the negative part of the story is troughed. Three consecutive quarters of negative revenue growth. That's in the rear view. Smartphone market was weak globally. That's going to be troughing as well.
Look, I'm not a big believer in there's a huge catalyst out there to move Apple higher. Okay, I know some people are putting the VisionWare goggles out there as the catalyst. That's fine. You can make a market on anything you want to. I just don't believe that. I think this is more, and I'm going at you, Joe, with this. This is more going to respond to the market overall. If animal spirits return and people are coming back to the market right now, just by definition, those non-discretionary buyers that you're talking about have to go to Apple. If you're anywhere exposed to the S&P 500 or the triple Qs. Now, what I think is interesting here, and I'm going to dovetail to something you said about the algorithms, because I said this to you on the air yesterday in a rhetorical last week, and I didn't quite get an answer. What happens? We were talking about interest rates. You were talking about interest rates a second ago. What happens when the yield curve all of a sudden disinverts? I think those algos, just to answer the question, are now going to pile on, and I think that's going to happen. So I hear you on, hey, we'd like to have the 10-year at 3 3/4, but I don't think so. I think you want to get it higher. Maybe the 2-year comes off a little bit, but when that yield curve uninverts, I think the algos are going to pile on. It's going to benefit Apple. It's going to benefit everybody in the market.
Let me ask you all this, because Friday's big story that we did was Stephanie Link selling Meta, right? She looks at the incredible price appreciation, Joe, of a stock like that, and it's like, look, I love it. It's just, I'd be crazy not to take some profits just given what the move's been. So I'm like, well, what about other big winners from November 1st that you guys are all in? CrowdStrike's up 70% since November 1st. Uber's up 50%. There are other names on the list which we'll get to as well. But these are, you know, growth names which have ripped.
Well, you never say never in terms of looking at a particular position realizing that it's been a significant contributor to your portfolio and saying, okay, do I need to reduce the allocation to this individual equity to manage the risk? So there's always that possibility that exists. In the case of Uber, that's in fact what I did towards the end of 2023. I pared back because I had a significant gain in the stock. I pared back the holding. In the case of CrowdStrike, there's a very strong thesis, a fundamental thesis, and a tailwind surrounding cybersecurity. And I think that's well entrenched. It's clearly so far been a dominant theme in 2024. And what would be the motivating factor for me to consider reducing the holding in CrowdStrike is to see a reversal of that trend, both in terms of the technicals themselves, but really in fundamentals, really beginning to hear the earnings story looking like it's decelerating. And if you do get that type of evidence, then yeah, you have to pare back the position. But until it does that, I'm going to stay with it.
Jimmy's stocks are right in the wheelhouse of his argument / concern about the broadening of the market, because the cyclical names that he's betting big on, like, you know, Greenbrier, for example, is up 30% since November 1st. GM is up 27%. You know, not much news. Thermo Fisher's up 25%. If your test, so to speak, right, calling this a test for these stocks, if that fails, what do you do with these names?
I think you got to trim them. I mean, this is the moment of truth to go back to where we started this. Now, Greenbrier, I'll just point out they're on an off cycle as far as when their calendar year ends. So they reported a few weeks ago. Pretty good earnings report, by the way. Now, that's it's a small cap stock. It makes rail cars. Rail cars, that's pretty cyclical, okay? So that's a good indication, but again, it's a small cap. You can't derive from that the overall cyclical economy is doing well, as much as I may want to. GM, on the other hand, is a major moment of truth. It's up, whatever you said, 27%. A lot of that, I think, is the accelerated share repurchase, where they're buying back about 20% of the company. Now, they wouldn't be doing that if they didn't feel good about their prospects, but those prospects needs to shine through, not just in the fourth quarter reports, but the guidance going forward. The stock is still ridiculously cheap. It's less than 5 times earnings. So, if I'm right, and I think I am, about the broadening of the economy, the broadening of the rally on the back of economic strength, GM will do well. Thermo Fisher, I would say this is more of a sector call. I think a lot of us have talked about healthcare this year being the year for healthcare. It was a terrible year last year. Thermo Fisher is one of the highest quality companies in the healthcare sector. A little pricey, I'll admit that. But let's see if this near-term momentum can run along with the sector as sentiment comes back to it.
All right, so we mentioned what Apple's doing, pushing back towards $200. NVIDIA's hitting an all-time high because chips have been crushing it. Best sector this year, semiconductors. That after having their best year, the SMH at least, in 20 years last year. Christina Partsenevelos joins us now because KeyBank reiterates NVIDIA's overweight. You do have some other calls in the space, but your beat has been going crazy.
I know, and I just happened to take a few days off during all of this. But let's start with AMD, because it seems like it's a little bit less optimistic. Analysts at Northland Capital are saying, hold your horses on AI. Yes, it's big, but it's not as big as investors are thinking, which is why they are downgrading AMD on valuation to a, quote, heck if we know rating. They believe right now AMD's AI earnings potential is just too inflated at the moment. That's why you can see shares are down slightly, but not the case for NVIDIA. That stock is up, 25% year to date after 240% ride last year. Speaking of NVIDIA, NVIDIA's CEO Jensen Huang just made his first visit to China in 4 years, just over the weekend. It's unclear who he met, but the visit does highlight NVIDIA's concerns about U.S. chip restrictions and this growing competition from local alternatives like Huawei. He also visited Taiwan to meet with Taiwan Semiconductor to secure production capacity for its current and upcoming AI chips. But not everyone thinks NVIDIA is number one for 2024. Morgan Stanley is replacing NVIDIA with Western Digital as its top pick, with a new price target of $73, and that's why it's pushing shares higher right now, over 4%. And the analyst Joe Moore says the stock is dirt cheap, and NAND prices, which is really just the memory is not associated with AI, so just think of it as a separate type of memory. And he said those prices are ripping higher. And then the major catalyst too is in the second half of this year, Western Digital will separate its NAND business from its hard disk drive, aka the storage business, which should unlock additional value. So that's why they're upgrading Western Digital and in replacing it instead of NVIDIA.
Jason, you want to chat about what's been going on with NVIDIA of late?
Yeah.
I mean, I remember this stock has just been incredible. You pick your superlative. You're the shareholder in it. You tell me how you're feeling about this move and whether you think it's a little too much, whether it's completely justified.
Yeah,
what do you say?
every time I say that, it keeps going higher, right? So the stock, to Christina's point, up 240% last year, 20+% this year. You know, think about the Meta move. 300,000 chips that they bought, right? So the demand is extremely robust. 300,000 H100s, right? And they're still innovating. They're on top of that build. So for me, the semi space, the cyclical space, they call them the new transports, all these things that we've talked about forever. It's very much in play, and I continue to think there's upside momentum there.
Yeah, Joe.
The concern, look, NVIDIA is nothing more than a reflection of what Jimmy's talking about with the animal spirit. It's a strong positive momentum and really the desire for ownership of quality within the market. We all know where AI is. The setup for the semis this week is somewhat concerning when you think about, well, where do we kick off semi earnings? We've got Texas Instruments, and then we'll hear from Intel. Texas Instruments has had 5 quarters of struggles.
You bounced on that one too, right?
I did. Weak demand for industrial equipment. Analog's going to be down double digits once again. So the setup for semis this week can be a little bit complicated when you're hearing some of the fundamental stories that certainly aren't going to sound as good as what you hear from AI, AMD, and NVIDIA.
That's a good distinction, Christina, isn't it? The tale of two chip kind of segments, whether it's on semi, Texas Instruments, NXPI versus the others that are getting all the limelight.
Yeah, and it's a great point by Joe, just because auto sector is also a concern, so that's weighed on semi and a few other like NXPI. Texas Instrument is exposed to EVs, but not so much. They're more diversified, so it seems like some analysts are saying, hey, the bottom may have hit for Texas Instruments, despite, you know, the 5 quarters of potential weakness. There's still some mixed reviews on Intel, but if I may just bring it back to NVIDIA, the thesis that Northland Capital had on AMD, they are arguing that there's a lot of stockpiling happening with these AI chips. China is going to slow down its demand in Q3 once they buy all their chips and start using alternatives. So I wonder why that thesis isn't used for NVIDIA, let's say, beyond the second half of this year, and why there isn't maybe more concern that this may taper off by the end of 2024.
Well, we'll have to wait and see what happens with their guidance and what the analyst community has to say about it. Christina, thank you. I appreciate it. Christina Partsinevelos. It's a perfect segue to, you talk about stocks going wild and some of these names that have gone crazy. We just got Greenlight Capital's annual letter to investors. David Einhorn, of course, who says that they returned 22.1% last year net of fees. And there's a line in here towards the top that I think sets up this conversation pretty well. 2023, he says, was a very good year for the partnerships. It had been tracking towards a great year until the last couple of months when the market took off and most of our short book performed poorly. Bubble-like conditions returned for the most speculative stocks, and a handful of our shorts went parabolic. I mean, look, he's known as somebody who certainly wasn't trying to, jump on these crazy growth stocks. He has always had, or at least for the last handful of years, this so-called bubble basket of names that, went against him and then for him when they, had a really rough year a year ago. So he talks about these speculative stocks going parabolic. Ed Yardeni has a note, guys, out today in which he talks about an exuberant melt-up phase, talking about which already might be underway and might become irrational. So 2 smart market watchers, one great overall market participant throughout the years in David Einhorn, went through a rough patch but has bounced back from that. What do we make, Anastasia, of some of this commentary? Speculative stocks, even, Ed Yardeni, who's as bullish as anybody on this market, talking about an exuberant melt-up. I talk about Apple coming back towards 2. I talk about NVIDIA, ripping higher among these other semiconductor names.
Yeah, I mean, if there's nothing to get in the way of the exuberance, why can't the market continue to roll on? And when I think about the setup right now, we talked about earnings that maybe started on a week basis, but I think that broadens out, and earnings can be a catalyst for markets. Then we talk about elections. People maybe sort of start to worry about it, but guess what? Stocks actually typically go up in election years more often than not, 85% of the time. And then you talk about Fed easing. Whether we want to debate whether it's March or May or June, the bias for the Fed right now is to ease policy. So I call it the 3 E's: the elections, the earnings, the easing. I think all of that right now is on the side of the market. And there was an interesting note, Scott, today from Tony Pasquarello, where he talked about that the Fed is now talking about cutting rates, but investors are also starting to think about what happens with tax cuts from the Trump era and whether they start to get extended. So I think for now, the market has a lot to support it.
One of these stocks we would have said fits right into this basket over the years was Netflix, right? And, Jason, you own it.
Yeah.
Remember, the stock was at 700, had this, huge decline down to what, 4, less than that?
Yep.
Well, it's back towards 5, okay? And it reports earnings tomorrow, which has always been a key moment for the FANG stocks. Julia Borston joins us now with what the setup looks like. Hey, Julia.
Well, Scott, Netflix is expected to deliver accelerating revenue growth and subscriber additions pretty much in line with last quarter's surprise beat. That's nearly 9 million. That's how many new subscribers analysts are projecting for Q4. That would bring Netflix's paid memberships to 256 million. Now, the other key number to watch is 11%. That's the accelerating revenue growth that Netflix forecasts for the quarter. Both numbers would reflect success converting freeloaders to paid subscribers, as well as advertising upside after Netflix announced 23 million ad-supported subscribers. They announced that just earlier this month. As rival streamers focus on profitability, Netflix's lead is seen as giving it an even greater advantage to license others' content and ultimately spend less on content. Now, despite the 36% run-up in Netflix shares since its last earnings, 60% of analysts have a buy rating, 34% have a hold, and only 6% have a sell. Scott?
All right, Julia, thanks so much. That's Julia Borston. She'll, of course, be all over the network tomorrow as we look ahead to that, and then we report the earnings in OT. So, Mark Mahaney, speaking of what Julia was saying, still some wind left in the sails, he says. What do you think?
I think so. I think, Scott, for me, as it relates, streaming is always on the docket, and it relates to all these players, right? And streaming has been slowing some. 9 million is a very solid number, right? And when I think about how they're monetizing that existing base, we talked about 23 million ad-supported tier new members, right? So these are folks that maybe are in the space where we're sharing somebody else's subscription, and then you're talking about the password share. So I think there is continued upside on the existing base. The free cash flow continues to grow. I think the one concern for me, though, is what happened with the strike. There's not a lot of new releases. The content library is strong, but there's not a lot of new releases this year, so we'll see how that goes.
Yeah, so the momentum is clearly back at Netflix, but this is a quarter where I don't know if it's as much the technicals as the fundamentals that's going to drive the direction. I think what's going to be important is the operating margin, returning the operating margin back into the mid-20s, and then also gaining an understanding coming off the Hollywood strike, which ended in the early weeks of October. Okay, what's the cost effect now on Netflix as we move forward? Because the writers obviously are going to be receiving more, and that's going to weigh on those margins themselves. So I think that fundamental element is going to be really important to understand as they give us a little bit of a road back into 2024.
All right, we got a lot of other names on the earnings list for this week, and we'll try and get through those before the end of the show today because we do have a lot of ownership on the desk. So I'm going to put that aside. We'll take a quick break. We do have more stocks on the move that the committee owns. We're going to talk trades on Citi and D.R. Horton, Lulu, and more. We'll do it next.
Dave.
All right, we're back. Let's hit some committee names that are on the move today. Let's talk Citi. Jimmy, okay. Warren Buffett apparently telling Jane Fraser, the CEO, to continue with the overhaul. Made that case over a lunch meeting, according to reports. You've been making that case during this lunch timing for weeks, right?
For some reason, I think St. Warren has a bigger voice than mine.
It's okay.
Look, it's nice to hear. It's not the thesis for being in the stock that Warren Buffett is in it, but it certainly helps. I agree. Of course I agree. Look, I think Jane Fraser, who's been at this for about 3 years as the CEO of Citigroup, has been doing all the right things. First, rationalizing the international businesses. And by the way, on that note, second half of this year, it looks like they're going to spin out the Banamex operation. That's a huge move, okay? That simplifies the structure of the business. Then domestically, doing things like getting rid of distressed debt and municipal bond businesses, those are hard decisions to make, all right? That's what you want a CEO to do, is make hard decisions, but ones that benefit the remaining businesses and shareholders. This all comes down to cost cuts and making the business simpler to understand, both for shareholders and for regulators, by the way. So Warren agrees.
Okay, Jason Snipe, let's talk some home improvement. Oppenheimer today cuts both Home Depot and Lowe's. They take it off Outperform. Right. You got Lowe's, okay, so they take the price target down to 230 from 275. It seems to be a near-term, more tactical call. They're taking a more cautious stance towards home improvement retail. What do you make of this call?
Yeah, and I think the call is pretty much just saying, hey, listen, there might be a better entry point later on down the road.
You agree with that?
I think it's possible. I don't know if I necessarily agree with that. I think part of the run. Listen, it's up 15% in the last 3 months. I think part of it is policy. I really like Marvin Ellison. I like what he's done with selling the Canadian business. I think their operational margins continue to grow and they're focusing on profitability. But when inventories are really low, like they are, these home improvement stocks can struggle. But I still like this one in this space.
So what about the builders, Joe? As D.R. Horton today gets downgraded over at Seaport, earnings are tomorrow morning before the bell. They also reiterate a buy on NVR. That's at a 52-week high today. I ask you because DR is in the Joe T and NVR is in the Joe T as well.
It sure is at a 52-week high. And look, you can't play both sides of the fence on this show. A few weeks back, I was talking about the distance between price and the 200-day moving average, and how in a lot of the semiconductors names, it had gotten extreme towards 25 to 30%. And that's the case for the home builders, okay? Let's be candid about it. When you look at D.R. Horton, you're nearly 30% with price above the 200-day moving average. So could you have a technical correction? Absolutely you can. What do you do with the information I'm giving you? You set the expectation. I don't think you do anything with your position because the fundamental conditions that are in place are favorable for the home builders. And the setup for 2024, if the economy is able to achieve the soft landing, if the Federal Reserve begins to cut rates, you're going to see a frozen residential real estate market begin to thaw out, and that's going to fundamentally benefit these companies. So be prepared, set the expectation you get a technical pullback, but fundamentally, I'm staying in these names.
So what about Lulu, which got downgraded today? The price target 500. The stock had a great run. As we've been debating Lulu's place in your portfolio versus a Nike, which have been going in opposite directions. So what do we do here?
Okay, so I read the note rather extensively, and they made the valuation argument. And what puzzled me about what they were citing is, yes, they said Adidas offers a better valuation, but they didn't move on Nike. And if you believe you've got this rich valuation in Lululemon, and you're suggesting that you want to look for valuation opportunities somewhere else, well, there's Nike, which obviously is trading at a significant discount.
Yes, for a reason.
For a reason, because they don't have the growth.
But not only that, but now they don't know what to do with it. Because the stock had this massive ramp into their earnings, which were a massive disappointment.
So there's where the valuation argument falls. And that's where the valuation argument falls, because what you have in the case of Lulu is you have strong brand momentum, you have strong revenue growth, and within the note they're talking about impending moderating growth. Okay, impending means may or may not happen. I'm not moving out of my position because something's impending.
Just on Nike real quick, I mean, I got lucky with where I entered it 2 quarters ago and sold it before this bad quarter that they reported. But it's on my watch list, right? This thing looks like it's going to break down below 100. And if it does, I think it's going to go test those 52-week lows. Now, I'm saying all that because at some point it does become a buying opportunity. I read the articles that they've lost their mojo. What are they doing with Tiger Woods? All that sort of stuff. It's Nike, okay? It's Nike. If this gets in the low 90s, I think you're supposed to pick it up.
All right, Pippa Stevens has the headlines for us. Hi, Pippa.
Hey, Scott. Well, President Biden releasing a statement on the deaths of the 2 Navy SEALs who were lost at sea during a mission off the coast of East Africa last week. U.S. Central Command confirmed their deaths today after a 10-day search. The president wrote that the SEALs represented the very best of the country who pledged their lives to protect their fellow citizens, and that his heart goes out to all who grieve these 2 brave Americans. Cargo theft has more than doubled in a year, according to threat prevention company CargoNet, which says nearly $130 million worth of goods were stolen last year. CargoNet ranks California, Texas, and Florida as the 3 top spots for theft. And for the first time in 33 years, an amateur has beaten the pros at a PGA event. Nick Dunlap, a student at the University of Alabama, won the American Express tournament in La Quinta, California, with 1 stroke on Sunday. Dunlap is the first amateur to win since Phil Mickelson in 1991, but unfortunately won't be able to accept the $1.5 million prize because of his amateur status. And of course, Scott, great coverage from you on the ground last week.
Oh, Pips, thanks. But it looks like he has some big paychecks, though, in his future if he keeps playing like that. Pippa Stevens, thank you. All right, coming up, we're searching for opportunities outside the U.S. Bob Pisani has that in today's ETF Edge when we come back. We are back on the half. Let's get now to Bob Pisani with today's ETF Edge. Hey, Bob.
Hey, Scotty. The U.S. stock market is at new highs, but international flows are all over the place. There's been huge inflows into India and Japan, which has reinvigorated overseas investing, but China flows are flat to down as that market hits multi-year lows here. Here to make sense of it all, Dave Mann. He's the global head of product and capital markets at Franklin Templeton. Dave, you oversee Franklin's ETF business. It's a big one. It includes India, Japan, China ETFs. Let's talk India and Japan. Why is India and Japan so hot right now with international investors?
Sure. Thanks, Bob. Yeah, India was one of our leading asset gatherers last year. FLIN's the ticker. You know, the growth story's been wonderful there. You know, also interesting to look at it from a, you know, it's a democracy. I kind of call it a noisy democracy when comparing it to something like China. So strong growth story, strong middle class. It's been an interesting one, especially compared to something like China from an emerging markets perspective.
And Japan?
Yeah, Japan has also been a strong one. That's always been an interesting one when we look at our, you know, sort of our international lineup. And you know, last year in the U.S., about half of flows were into U.S. equities, half were not equities. Japan's always been that sort of its own region, and you know, part currency, part you know, the Japanese central bank and what they're going to do. So strong flows into that one as well.
So at the same time, I'm watching China. The inflows have been flat. Some of them are seeing notable outflows. Hong Kong and the mainland China indexes hit multi-year lows. The Shanghai and Shenzhen indexes, they've gone nowhere. 2007 levels is where we're at right now. So your China ETFs have all the big names. I see Tencent, Alibaba, Baidu. Why are investors fleeing China right now?
Yeah, I mean, there's been a lot of noise around the politics out of China and how you know, the growth story that people have enjoyed for the last decade is going to start decreasing. But you know, one of the things with these China ETFs, I mean, they still have a ton of assets, and you know, it drops by double-digit percent. Some folks will look at it as a buying opportunity, and then this year it's down another double-digit percent. So I think there's just been, you know, it's been an important asset class. It's an important part of the global economy, and investors are kind of just gauging how far this thing's going to go south before the recovery starts. Right.
Finally, I just got to get a quick update. You also run the Franklin Bitcoin ETF. So that's one of the 10 new ones that are out there, 9 actually. How is it tracking Bitcoin? I see a respectable $4 billion in inflows for the 9 new spot ETFs that have launched. That seems pretty good to me. Are you tracking well? That's what the viewers want to know about this right now.
Yeah, the funds are doing what they're supposed to do from a tracking perspective. That was one of the big unknowns in terms of you know, building out all the plumbing, so to speak, is, hey, this thing's going to own spot Bitcoin. They want the ETFs to track the price of Bitcoin, and that's exactly what they've all done so far.
Okay, terrific. We're going to have a lot more on international investing, what's going on with the flows, and the Bitcoin ETFs coming up. ETF Edge at 1:15 p.m. Eastern Time. And Dave is going to be joined by Mike Akins. He's the head of ETF Action. A lot of opinions on his part on where ETFs are going. That's etfedge.cnbc.com. Scott, back to you.
All right, Bob, thank you. Appreciate it, Bob Pisani. Coming up, more ideas for your portfolio. A handful of bullish calls today on the transports. We will debate the best ways to play that group in just 2 minutes. We are back. Want to hit some transports today because, Anastasia, we'll go to you first. Doing this because Union Pacific and Norfolk Southern got upgraded today to outperform over at Bernstein. What about this group?
I really like these upgrades. I think they're very timely. When you look at the Dow Jones Transportation Index, it has largely been range bound for the last 2 years. And the reason for that is because after the pandemic, we've accumulated these inventories and we then had to destock them. And nobody was restocking, so you didn't have to move more stuff. But today, we're on the other side of that. If I look at inventories, we have destocked quite significantly. And if you look at the manufacturing gauges, they're sort of around 50. So that to me suggests that if we're going into this true soft landing economy and demand actually sustains and picks up, inflation moderates, rates could also spur a demand pickup, you could have this restocking cycle. So we are going to have to move stuff again. And so when I look at the demand for trucking, for rails, for example, that has collapsed, it is now going through a bottoming process, and we're starting to get some green shoots from the commentary from shippers, and also they expect rates to go up as well. So I like picking up that sector here. And if you look at the ETF like IYT, for example, that's rails, that's freight, that's trucking, that's marine transportation. So if you think that the world's going to move more stuff, that's a very timely call.
Okay, Jimmy, so if you want to get more stock specific, we mentioned UNP in one of the calls today. So price target goes to 280 from 229. The firm calls it the best rail franchise in the U.S. You own that one.
Yeah, I do own it. I'm comfortable owning it. I take great comfort and agree with what you just said, Anastasia. The one thing that's interesting is the call that this is the best Class 1 rail franchise in the U.S. I'd like to believe that, but I need to see that proven in the results. And here's why I'm saying that. The stock really languished for about a year and a half until Jim Vena was announced as the CEO last summer, and it promptly has risen 20% since then. But now trading at 21 times this year's earnings, that's just a touch rich unless what Anastasia just said comes through. We're shipping goods again, and those earnings estimates are nicely beaten. Again, that's a show me sort of story.
JB Hunt, Joey is yours. It got upgraded today. The trucker to buy it. This is at UBS. Price target to 234 from 205. Says the company, quote, provides strong leverage to a freight cycle turn.
March 16th, 2022, Federal Reserve first rate hike. That's the high for JB Hunt. Been in a consolidation range ever since. This note cites the potential for a margin bottom, which I agree with. More importantly, understand something about individual stocks. Stocks that fall on strong volume tend to fall even more. Stocks that move higher on strong volume tend to even move higher than where they were. And that's the case of JB Hunt the last several days. It's rallying strongly, and the volume is increasing significantly. I think it goes higher.
Okay, coming up, we will go through more key earnings to watch this week. Mike Santoli, though, joins us first. He'll do that next. Welcome back. Our senior markets commentator, Mike Santoli, joins us now with his midday word. All right, we did it. We made new highs. Now what?
Yeah, I mean, we did it. I think you can give credit to the S&P 500 for finally breaking to this new high. It's 2 years and 2 weeks since the prior one, while also acknowledging that there are soft spots. Maybe we didn't have enough of a kind of a payback phase coming into this year just yet. Today, a little favorable rotation back toward the majority of smaller stocks and cyclical stuff. I think you can also really welcome the fact that the grip of the bond market might have loosened just a little bit. You didn't require a big drop in yields for every bit of upside, but kind of open to both sides here, waiting to see what kind of sentiment and positioning does. There has not been a really aggressive chase into the market to this point. I'm not sure that just a marginal new high is going to bring that. And I think that's something that you can also kind of take a little heart into, because it's not as if people, got real overheated in terms of the greed zone, at least not 3 weeks into the year.
We'll see how we look in just a couple hours from now when we see each other on Closing Bell. Mike, thanks. That's Mike Santoli, our senior markets commentator. Coming up, we'll give you your earnings setup for the big week ahead. Many names are on our list. We'll trade them next. We're going to rip through some earnings expectations this week from the committee. P&G, tomorrow morning, before the bell, Jason Snipe.
Yeah, so for me, stock has obviously been relatively flat. I think the real focus for me is on margin growth and seeing how they obviously have some innovative product solution changes. So let's see, that's help with pricing. Let's see how that plays out in the quarter.
ServiceNow, you get that one too. They report Wednesday. You own it.
Yeah, ServiceNow has been a juggernaut, as you know. And again, they've made a couple of partnerships, one with NVIDIA recently and Amazon. So I like the AI catalyst. I think it continues to play well for the stock.
Joey, Amex on Friday. Obviously we were just with CEO Stephen Squeri out at the Amex golf tournament. Quiet period, so he couldn't get specific on where things are. But you own the stock. What do you think?
Phenomenal event. Stock looks technically incredibly strong, caters to the affluent consumer who was remarkably resilient during the normalization process from the Federal Reserve and really was unaffected by rates rising. In fact, positively impacted by capturing a higher savings rate. If there's one thing to watch for any credit deterioration. That will challenge the 10% revenue growth target.
Give me quickly Colgate, Palmolive, Jason Snipe, which reports on Friday of this week.
Yeah, so Colgate, a little bit different story. I mean, the price action has been relatively strong for a staple. You know, it's up about 10% in the last 3 months. Again, inflationary costs are going to be a concern, how freight and supply chains have worked out.
All right, we'll do finals next.
The 31st.
We have one of this country's top wealth advisors on with me today on Closing Bell. Cheryl Young is going to be right here on set with me at the stock exchange, so I look forward to that conversation. Keith Lerner of Truist. Chris Verone gives us the technical perspective on this market, where we go from here after these record highs. And Schwab's Kevin Gordon with his playbook as well, so I'll see you all 3 o'clock Eastern time. All right, Farmer Jim, what's your final trade?
NXP Semiconductor. A couple of weeks ago, Mobileye really gave a question as to the strength of the automotive market. I think it's a lot stronger than Mobileye indicated, and NXP is the way to play it.
Okay. Jason Snipe.
Costco, discretionary trends are improving. I really like this stock here.
I was going to ask you about that earlier. This stock's up like 25+% since November 1st.
Yeah.
Stay with it.
Stay with it. Stick with it.
All right. Anastasia.
Right there with Jim on semiconductors. You stick with it because this is the year we go from multiple expansion to actual revenue growth for the industry. So I'm sticking around for that.
Joseph T.
For my cyclical loving friend at the end of the desk there, Citi is the one name that I actually think is breaking out.
Thank you.
Got your eye on that. Okay. See, this could be going somewhere. All right. We'll see you on Closing Bell. The exchange begins right now.
Scott, thank you very much. I'm Tyler Matheson in today for Kelly Evans. Here's what's ahead this hour. Stocks hitting new highs to start the week, but can the rally keep going? We're going to take a look at the catalysts and the potential headwinds from here. And one group of stocks our market guest is especially bullish on. Plus, is this the year we will finally see the IPO market come back big time? Our guest says there will be movement and it will be high quality. He'll tell us why, and the tech candidates he sees leading the charge forward. And three more names on deck to report. We have the action, the story, and the trade on Lockheed, D.R. Horton, and United Airlines. But we begin with today's markets and Dom Chu with some record-breaking numbers. Dom.
Record-breaking for sure for two of the three major indices, Tyler, to your point here. The Dow Industrials, I'll put a star right up here because it hit a record intraday high so far today. The S&P 500, also a record intraday high. The Dow Industrials currently up about 1/3%, 114 points, 37,977 the trade there. The S&P 500, 4851, up about 1/4%. At the highs of the session, we were just around 4868, call it, right around there, and then 4847 at the lows of the session. So kind of tilting towards the lower end of that range, but generally a positive day so far. The NASDAQ Composite, 15,362, is up about 1/3%, 50 points to the upside. Also watching what's happening with one part of the market across the Pacific Ocean. Check out what's happening with the iShares China Large Cap ETF, ticker FXI. It's down roughly 2.5% today. But the reason why I put this chart up here is at one point today, on the intraday lows, you'd have to go all the way back to October during the financial crisis in 2008 for the lowest levels there. So some folks are wondering when the downside momentum is going to stop on China. But for right now, those shares still down 2.5%. That trade has been decidedly to the downside for quite some time now. We'll see if that sticks. And then the stock of the day right now is Macy's, department store chain. You know what's happening. Ark House Capital, Brigade Capital, that joint bid out there for $5.8 billion, $21 a share, rebuffed by Macy's board. They don't know how the financing is going to happen in some substantial way. So those shares up 2.5% right now. So keep an eye on Macy's. Over the course of the last year, still down 21%. Tyler, send things back over to you.
All right, Dom, thank you very much. See you shortly. Not just investors who are feeling optimistic today. A new survey out shows that business sentiment is also taking a turn upward. Steve Leisman is here with the latest. Steve.
Tyler, good afternoon. There looks to be a rash of optimism breaking out over the economy among both businesses and consumers. The latest survey from the National Association for Business Economics finds the 3-month outlook for sales, profit, and CapEx surging. And that 61% of the 57 responding companies forecast rising sales over the next 3 months. That's the highest percentage since the second quarter of 2021. A net 30% see improved profit margins. That's above the pre-pandemic level and the best since 2015. CapEx, meanwhile, improved by 17 points from to about average, and fewer businesses expect to charge higher prices. That's a good outcome there. Likely driving business sentiment are the same factors that are leading to a more upbeat consumer. You got lower inflation, higher stock prices, and the prospect that recession may have been avoided while the Fed could soon be cutting interest rates. On Friday, the University of Michigan reported the biggest one-month surge in consumer sentiment since 2005. Now, it remains, as you can see there, below the 2019 level, but it's now rocketed up for 2 straight months with big gains. There were some areas of concern in the NABE survey. Hiring intentions were muted, while wage growth is still expected to be strong. But those challenges come now, Tyler, with both business and consumers feeling more upbeat about the outlook. It's a better way to take a challenge.
You've got business looking more upbeat. You've got consumers, as you said there in the University of Michigan survey, looking more upbeat. You've got inflation coming down. I wonder, to inject politics into this, why the Biden administration isn't claiming more credit here or isn't getting more credit for this economy. Not that they necessarily deserve it. A lot of it is coincidence. It's not necessarily directly tied to policies. But I can well imagine that if the tables were turned, that a Trump administration would not be bashful about claiming credit.
It's true, but of course there's differences between the current president and the former president in terms of their bashfulness or not, I guess is one way to put it. But Tyler, I am interested to see if there have been any changes at all in the national polls. Most of the polls I've seen recently have been local ones, and our CNBC All-America survey just barely picked up the beginning of this optimism in December. It was just a small notch, and it's shown up much more strongly the last couple of months. So I'm interested to see if at least people are not giving as much blame to Biden as they did before. I do think that it may be a situation where they've made up their mind about the president. They went through hard times from higher prices, Biden was president, whatever the reason, either to blame or not, but they're going to finger him for it, and they may not be able to change their mind about it.
All right. Steve, appreciate it. Steve Leisman reporting for us on business sentiment. Well, business sentiment may be breaking out now, but the market has been rallying since the fourth quarter, led by large cap technology. Don't need to tell you that. Our next guest says that trade is getting crowded, and it's time to take a look at value, especially small cap value, which he says will be the leaders from here. Joining us now, Sandy Villery, partner and portfolio manager at Villery & Company. Sandy, welcome back. Good to have you with us. Have we skirted the recession?
Yeah, I mean, I think we are going to skirt this recession. I mean, I kind of see GDP ending the year 0.7% to 1.4%, and we sort of avoid it completely. I do think that inflation is going to be a little bit stubborn, and so you're not going to see the rate cuts as quickly as maybe the street thinks. And so when you go back to 2022 and you're looking forward to a lot of rate hikes, growth certainly sold off dramatically. And then in 2023, when rates came down, growth had an unbelievable year. I just don't think that I think that rates are going to be, lower not until the end of the year, which is going to cause large cap growth, which is quite overvalued, by the way, versus 20-year averages, et cetera, to really stall. And then the action is going to be more in these smaller cap cyclical value names that are very undervalued versus their 20-year average.
Mm-hmm. Did I hear you say that rates came down in 2023? That's not my recollection. I mean, at the end of the year, rates backed off a little bit, and as there was increasing sentiment that the Fed was going to cut rates, but the rates for most of 2023 were moving higher.
Well, when you look at the 10-year going from 5%, really crossing under 4%, and they sort of rolled over that way. And now on the 10-year, you're back up to say a 4.13 or so. So I think that rates are going to be, maybe under 4 as opposed to really, taking off from here. So kind of an interesting setup.
So looking at where things were in October, where they sit now, and the forecast for the rest of the year, you see rates coming down.
Right.
Small caps. Why small caps? Why value? And give us some names.
Yeah, I think with a little bit of growth coming and rates doing what they're going to do, I just think they're mispriced. When I look at things like, Atlas Energy, I think energy is going to do quite well. They're in the middle of building a 42-mile conveyor belt system in the Permian Basin and just mining and delivering sand, a very simple, high cash flow business that's I think, mispriced. And so I think that's one that's interesting. Pool Corp, the largest supplier of swimming pool products in the world, I think had trough earnings in 2023 and will certainly look better in 24 and beyond. And I think the consumer is a little bit more resilient. And then I look at Palomar Technology, which is another name that only trades at 15, 16 times earnings and growing quickly. That's kind of been left for dead by the rest of Wall Street as they chase the Magnificent Seven. And so I think that's also an opportunity to be in a name like that. That's again just been unfound, and hopefully people find it.
You say the trade in growth, and especially large cap tech, is crowded right now, and that you think you'd rather be in small cap or large cap value. I wonder, does that suggest that it's going to be a bad year for large cap tech and the Magnificent Seven, or just that the smaller caps are going to outperform them?
Yeah, I think it's going to be more of a stock picker's market. And I think a lot of those larger cap Magnificent Seven are just going to stall. I think that you could see a little bit of a pullback in the names depending on where rates go. But again, I think with inflation being a little bit more stubborn, you may not see those cuts as quickly as people think, making large cap tech sort of stall out. And then when people are digging through the rubble and looking for, other names, I think they're going to discover that small cap is quite reasonably priced, and money could be allocated towards those sectors.
Sandy, good to see you, my friend. Sandy Villery,
Thanks, Tyler.
Villery & Company. Appreciate it. We've talked about optimism in the markets and among businesses, and it seems optimism in the IPO market is growing just a bit. Bob Pisani has more. Hi, Bob.
Hello, Tyler. Good to see you. IPO watchers are hopeful that markets at new highs will finally open up the IPO business, which has endured 2 disastrous years in 2022 and 2023. The calendar is starting to open up modestly. This week, BrightSpring Health, a home and community-based healthcare service, is scheduled to begin trading at the NASDAQ and could raise $900 million. And next week, Amer Sports is scheduled to begin trading at the NYSE. Amer owns several well-known international sports brands, including Arc'teryx, Salomon, Wilson Sporting Goods, Atomic, and Peak Performance. They could raise $1.7 billion, and it's scheduled to begin trading February 1 at the NYSE. Here's the positives for the IPO market. The markets are at new highs. That's good news. Interest rates are trending lower. Good news. And there's an AI craze out there that many hope will flood the market with AI IPOs later in the year. The big negative is a continuing valuation overhang. That's the haircut that many IPOs had to take after higher rounds of funding in 2021 and 2022 put premiums on companies that the public investing community was unwilling to support. The result is many companies decided they didn't want to or couldn't afford to go public. A number of companies have filed to go public with the SEC, some of them confidentially, including Service Titan, which provides software for residential and commercial heating, social forum network Reddit, canned fruit maker Del Monte, restaurant chain Panera Bread, online ticket marketplace SeatGeek, Chinese fast fashion retailer Shein, and cryptocurrency issuer Circle. It's a big list here. Auto rental marketplace provider Turo also filed public, as did healthcare payment firm Waystar. The list of potential IPO candidates, they haven't filed, but they're out there, include payments firm Stripe, buy now, pay later service provider Klarna, some smaller companies with public brand recognition like canned water company Liquid Death, you know them. They could dive in, as could Kim Kardashian's shapewear brand. That's called Skims. AI is the big theme for 2024. It's often mentioned as IPO hopefuls out there include cloud analytics firm Databricks, as well as Rubrik. That's a cloud data management and enterprise platform backed by Microsoft. Gaming-focused voice chat service and social network site Discord, also frequently mentioned as an IPO candidate, as is cloud security provider Wiz, which raised $300 million in a Series D round of financing that valued the company at $10 billion. So you see, Tyler, there is no shortage of potential companies out there. We'll just have to see if it starts opening up. This one with the sporting goods company is going to be a big one, though.
You mentioned a tremendous number of names there, including Waystar, which I think was the name of the company in succession, but I can't remember. I'm not 100% sure. But at any rate, that does not mean that all of these will necessarily go public, does it? There's some that will, but it may be a small percentage of all those you mentioned.
Yeah, so the ones that potentially win, include anything with an AI theme, they may be able to stay private longer and avoid this valuation haircut trap. That's what killed a lot of companies last year. They're not willing to take the cuts that the public market is demanding after they had huge valuations in 2021, 2022, and into 2023. I think that's going to be the big issue. The good news is the market's at new highs, lower interest rates. That's a perfect scenario for the market right now. And we probably have several hundred potential IPOs waiting out there. Some of them are 10 years old. Reddit filed to go public over 2 years ago. That's already a middle-aged company by now. There's plenty of venture capital and PC firms eager to find a way to get these companies public. Tyler.
All right, Bob, thank you very much. Bob Pisani. Our next guest expects a second wave of IPOs, but he says it's not going to be a huge flood, and we might not see those AI startups in the public markets until the 2030s. Joining us now, Duncan Davidson, founding partner at Bullpen Capital. So you have a somewhat more nuanced, not more necessarily, but a nuanced view of what we should expect, Duncan, in 2024 in the IPO market. More a trickle than a flood, or somewhere in between?
Well, if you look at history, after the dot-com bubble, we had a second wave, Google and then Salesforce. It wasn't a big wave, but these are the companies you wanted to get into and hold for a long time. If you go back even further to the PC bubble, I don't know if anybody remembers the PC bubble, but I was around for that. It was a crazy time, like the dot-com bubble. There was a company called Kentucky Fried Computers, went public, changed its name. There was a company called NBI. It meant nothing but initials, went public. 3 years after that thing blew up, Microsoft goes public, Oracle goes public. So I call that second wave companies. These are really high quality companies. They're the companies you want to buy and hold because they might become the future Magnificent Seven.
So where are we now? Are we at that point where what's going to come public may not be a torrent, but it may be a higher quality of company than at other times in the cycle?
Yeah, exactly. And I think, in fact, this is good. People sort of have a thinking in their head that drop interest rates, we get a lot of good stuff in IPOs. No, the higher interest rates cull the herd of unicorns. Only the top quality ones should get out. And I think this is a good thing. And investors should look at this as a buy and hold opportunity and not a buy and flip opportunity.
In tech, what are the names that you think will come out, and how do you rate them in terms of quality and investability, not necessarily for the short term, but rather for the long term?
Well, from a unicorn horse race, so to speak, I think Reddit will be the first one out, may even get out in February next month. If it does well, the other social ones like Discord will follow. The one I really want to see get out is Chime. It'll be the largest market cap of these companies. Fantastic company, neobank company. If it succeeds in getting out, then we have Plaid, which has been trying to get out forever. We have Stripe, and maybe Klarna all getting out, sort of in a fintech follow-on from it.
What has been holding
That's my prime list. The others that were mentioned, I'm not sure will be ready or want to go out in this cycle.
So what holds them back? You said they've been trying to get out forever. What is the impediment there?
Well, the market just didn't want them. You know, you go to a free seller or you talk to bankers and they say, now's not the time. So that's what the impediment is. But I think the time is coming. I think the bankers are going to say, hey, this is a time to go back out again. The market's doing very well. You guys are such solid companies. Put it very simply, these are the tech companies that create enormous alpha. High interest rates, low interest rates, doesn't matter. They're creating a lot of value all by themselves.
What was the surge? We have this chart up here, 2020, 2021. What was the surge driving it then? Rising markets?
Oh, ZERP, low interest rates. I mean, come on. Bubbles are created by crazy low interest rates. And so you get crazy bubbles.
And so as interest rates come down, you would expect some of these other companies to finally get over the fence.
Well, quite the opposite. I think if interest rates don't come down, or maybe come down a tick or so, it'll still let the animal spirits run for these companies. If interest rates drop too much, if we push them back down again, then you get a lot of weak offerings. Put it differently, these companies are better off if the herd of unicorns get culled and only the top quality ones still run.
Is the SPAC craze over?
Yes.
Yes.
Go ahead.
Finish your thought.
The SPAC companies were highly speculative and they've collapsed and nobody wants to touch a SPAC.
Nobody wants to touch a SPAC. Duncan, thanks so much. Appreciate your time today.
Take care.
Thanks for helping us. Duncan Davidson, Bullpen Capital. Coming up, chip stocks have had a big year, and our next guest sees those gains continuing because of one catalyst in particular. Just upped his price target on several stocks. He's here with some names next. Plus, top auto analyst Adam Jonas says each day brings more signs that global EV demand is slowing. Hertz, selling a third of its EV fleet, is one example of that. The stock is down 17% over the past month, but if you think that's an opportunity to get in, our guest says don't do it. She'll tell us why ahead when the exchange returns after this.
This is The Exchange on CNBC.
Welcome back to the Exchange, everybody. Shares of NVIDIA starting the year strong, up 20% so far this year after its massive run last year. It's more than tripled in value in 2023, by the way. Maybe that's why CEO Jensen Huang was dancing on his recent trip to China. It was his first trip to the country in 4 years as chipmakers try to navigate U.S.-China tech tensions. He reportedly met with NVIDIA staffers in several offices. Unclear if he also met with government officials, but he's a good dancer nonetheless. And while Washington is expected to tighten its grip on U.S. exports of advanced chip to China, our next guest is bullish on the sector, expecting increased spending in generative AI to fuel another rally. NVIDIA, one of his top picks, as is Intel, which will report fourth quarter earnings later this week. Let's bring in Srini Pajuri. He is a senior semiconductor analyst at Raymond James. Srini, welcome. Good to have you with us. So you think that the AI-led rise in a lot of chip stocks has legs, is going to endure this year. How much growth is it going to deliver?
Yeah, thanks, Tyler. First of all, if you look at the semi cycle, I think we started this rally sometime in October of 22. And so far, the rally has continued very strongly, has outperformed the S&P. The SOX index has outperformed the S&P by about 45 points. If you put that into context, typical semi cycles last, roughly about 2 years. And you get about anywhere from 30 to 50% outperformance versus S&P. This time, we're in the 15th month of the rally, and so far, the sector has delivered about 45% outperformance. Normal times, we would say we're probably in the 6th or 7th innings of the rally, but because of AI, we are still continuing to recommend the sector, recommend the stocks in the sector. And our view is that AI roughly accounted for about 9% of the industry revenue last year. And we expect it to grow about 100% this year. Actually, last year it grew about 200%. This year, AI revenue will grow about 100%. And over the next 2 years, we do expect AI to account for about, 7-8% of the industry growth. And this is an industry that actually grows in mid-single digits. So AI itself is, helping drive that, high single-digit type of growth. So overall, we expect the semi industry to grow at a double-digit pace because of AI for the next 2 years.
So that is an encouraging outlook for the companies that are exposed to AI, and there are a lot of them. We'll get to them in just a moment. But am I understanding correctly that you think that there is an even longer-term play that will give the AI sector, as it matures, even greater growth deeper into this decade and the next decade?
Yeah, again, this is something new that we haven't had this kind of a catalyst in a long time. Maybe you can go back to the late 90s in terms of the internet build-outs. But as I said, right now, the most of the benefits of AI are going to NVIDIA, as you mentioned. We expect that to broaden out over the next few years. We're starting to see companies like Broadcom and AMD this year. And then memory, for example, Micron will be a play on this going forward. And even some of the network connectivity chips, companies like Marvell and Broadcom are going to benefit from. So we see any supplier that supplies into data center to benefit from AI. And then on top of that, there's a lot of talk about on-device AI, edge AI. People are talking about AI PCs, AI smartphones. It's very, very early days. I think it's difficult to put a number or magnitude or the duration on this catalyst, but we think it's going to be big.
So as you look at, people can't get enough of NVIDIA, and I saw you have a $700 price target on that stock.
Right.
Wow. They're just going to own it?
I mean, look, valuation-wise, it's not that expensive. Even though the stock has had a massive run, the estimates have gone up even more. So, this is a stock that used to trade at 40 times on forward estimates. Right now, it's about 30 times. I think there's some concern that things could slow down a bit. We don't see that in the short term. Longer term, there's always that risk that things could take a pause for a quarter or two. We won't be too worried about it because it's such a long-term massive trend that if there's a pause in the next 1 or 2 quarters, we would actually view that as an opportunity. So at 700, we're still talking about 35 times forward numbers.
I mean, it's really gone. I mean, now it's really $600 a share. It's gone up $100 a share easily in the last, I guess, 3 months, something like that. Let's talk a little bit about a company that has been among the unloved in recent years, and that would be Intel. You have an outperform on them. I don't know whether that's a tepid endorsement or a relatively, it's a pretty enthusiastic endorsement.
Yes, I think we've been positive on Intel since last year. Stock did quite well last year, and you're right. It's an out of consensus call. It doesn't get much love. But our view on Intel is that as long as they execute on their roadmap, which they seem to be doing, the stock continues to work. Yes, PC is coming back a bit. We do expect the server business to come back a bit this year, but at the end of the day, what matters for that stock is their technology roadmap, and they think they can eventually regain the lead in manufacturing from TSM, which they used to have 2 years ago or a few years ago. They lost it. And if they do regain the lead, I think that opens up a lot of things for Intel. First, it does stop the bleeding on their share losses in servers. And then it opens up the foundry opportunity, which is a significant opportunity. And then it also opens up the AI opportunity. So as long as they're executing, we'll continue to support that stock.
Let's talk a little bit, quick thought, if you would, on China and how export controls and the chip business in China, import controls as well, may be headwinds in this sector.
Yeah, I mean, there are a lot of restrictions already in place, and NVIDIA will see some impact. But, the good thing is that the demand in other regions are so strong. The impact is minimal in the short term. Longer term, there will be some impact. And also, NVIDIA is implementing some workarounds. I think they're working with the U.S. government to implement some workarounds. If that happens, that's going to be upside to our model. But even without China, we feel pretty good about NVIDIA's numbers, and that applies to most other AI suppliers as well. The only difference is that NVIDIA, has had significant exposure to China, roughly about 20 to 25%. The other, companies are barely shipping AI products, so the impact is not as significant. But even with the China restrictions, we feel good about NVIDIA's numbers for the next 12 to 24 months.
Srini, thank you very much. We appreciate your time today. Srini Pajuri.
Thank you.
Thank you. Coming up, Delta warning about rising costs in its earnings report earlier this month. Those shares down nearly 11% since then. So will United follow suit before the bell out with earnings tomorrow? We'll preview those results. And sticking with airlines, the FAA expanding its inspection recommendations for certain Boeing aircraft. The details and the travel impact ahead. The Exchange will be right back. Welcome back to the exchange, everybody. Markets right now are higher. The Dow Industrial is up 61. That's off its high of a positive 245 or so. S&P higher by about 0.1%, 0.2% for the NASDAQ. Here's some of the movers this hour. Gilead having its worst day since December after disappointing results from a cancer drug study. The stock was at a 52-week high as recently as Friday, not today, down 10%. SolarEdge having its best day in a month on plans to cut 16% of its workforce. Best day for the stock, not so much for the workforce, in a restructuring. The stock is down 23% in the past month. Other solar and clean energy stocks are higher as well as SolarEdge. And SentinelOne higher after BTIG upgraded the stock to buy on rising attack volumes. Palo Alto and CrowdStrike both tracking for record closes today as well. And CrowdStrike CEO George Kurtz will join Jim Cramer on Mad Money tonight. That is at 6 p.m. You knew that. That's at 6 p.m. Eastern right here on CNBC. Let's go to Bertha Coombs for a news update. Bertha.
Hi, Tyler. Cameroon began the world's first malaria vaccine program for children today. The Central African nation hopes to vaccinate about 250,000 children over the next 2 years with one of the 2 approved vaccines. Now, while the vaccines are only about 30% effective, the World Health Organization says they will dramatically reduce severe infections and hospitalizations. Thousands of faculty members throughout the California State University system walked off the job earlier today, demanding higher compensation. The proposed 5-day strike will affect almost 460,000 students across 23 campuses, making it the largest university strike in U.S. history. And police in Roseville, California, arrested a woman for allegedly stealing $2,500 worth of Stanley travel cups. She allegedly walked out of a store with a cart full of the quenchers, then took off. Cops responded. They displayed some of them on the hood of a cruiser, saying, quote, "While Stanley quenchers are all the rage, we strongly advise against turning to crime to fulfill your hydration habits or perhaps resale." The suspect was arrested for grand theft, or Tyler, I suppose I should say grand theft water?
Grand Theft Water or Grand Theft Auto, whatever. Bertha, thank you very much. Coming up, near-term options in United imply a 7% move in either direction. And that's just not very helpful, is it? It could go 7% higher. It's not helpful. But we'll talk about that, as well as Lockheed has only missed on earnings 4 times in the past 20 quarters, with shares gaining more than 12% since the last Fed meeting. One firm says rate cuts may already be priced in. For D.R. Horton, we'll have the action, the story, and the trade on all 3 in Earnings Exchange next.
CNBC.
Welcome back to the Exchange, everybody. Earnings season ramping up after last week's big bank results. And today we've got the action, the story, and the trade on United Airlines, Lockheed Martin, and D.R. Horton. Joining us for this earnings exchange, Jeff Kilburg, KKM Financial CEO, and a CNBC contributor. Jeff, good as always to see you. Let's talk United. Reporting after the bell, had a bit of a rough go lately. Shares down more than 30% in the past 6 months. Certainly not being helped by those MAX 9 groundings. 79 United aircraft set to be grounded until Friday. Susquehanna highlighting the importance of airline capacity and routes as travel settles down following that reopening surge. You would sell into earnings here, Jeff?
I would. If you really wanted to define with options, I think you can, but I can't own the stock going in. I own Delta, which is not doing just as well. But if you think about the impact of the MAX 9s, United Airlines, which is called the Friendly Skies, is not feeling so friendly right now because nearly 100 of their 1,000 plane fleet, about 79 of them are the MAX 9. So you wouldn't think it'd be that impactful, but nearly 10% is being grounded right now. So there's so much ambiguity. The FAA continues to seem to look for more and more tests and more reasons. So I think the stock technically, Ty, if it gets back above its 50-day moving average, which is up at $40.50, I'd be interested again. But right now, it doesn't seem like the story is over yet. Yeah. All the sectors of airlines are really taking some heat this week. And we're going to find out with all the earnings. But United, I have to stay away.
The story is unfavorable right now. Let's talk about one that you do like, and that's Lockheed Martin reporting before the bell tomorrow. Shares up about 3% over the past year. That's not much, but rising global geopolitical tensions have refocused attention on defense, as you would expect, and specifically on Lockheed's F-35 aircraft. J.P. Morgan sees upside because of its growth strategy and aggressive share repurchases. You are a buyer here, sir.
I am a buyer. This is an essential 40 name. I've owned Lockheed Martin. I think when you talk about the election year that we are in, either side that ends up winning, I think you're going to talk about the geopolitical tensions that are continue to come on a horizon. I think this is a name that's going to participate in that upside. So when you look at a competitor, Northrop Grumman, it trades a little bit to a discount to Northrop. So forward earnings right here, about a P/E ratio of 17 versus Northrop about 19. So I want to be an owner here. If you're not an owner, I think this makes sense. This is kind of a boring name, Ty, but when you talk about the world we live in, owning these blue chip tangible names like a Lockheed Martin makes a ton of sense moving forward.
Let's go to D.R. Horton, also out before the bell tomorrow. Home builder up 66% in the past year, but Seaport downgrading the name to neutral today, saying that future Fed cuts may have been priced in during the run-up. The firm also watching input cost deflation, which analysts say could be slower than expected. You lean positive on this one, or is it one to watch because of its past gains?
Well, I disagree with that note. I think there's more room to run here. I think housing, there is a supply issue. But D.R. Horton, this is the biggest builder. They're going to put 82,000 homes out there. And yes, they had a monstrosity of a year in 2023 when they're up 72%. But if you're a shareholder right now at all-time highs, you feel like Jason Kelce jumping out of that box with Taylor Swift. You're so excited about what's going to happen for the rest going up to the Super Bowl. So where I think D.R. Horton can go is higher. I think actually the win in the sales for this could be lower interest rates. So that's a tailwind, not a headwind, and I don't think it's priced in. So I want to be a buyer here. I know it doesn't feel good buying something up 72% the year before, but if you have an opportunity on a pullback here, I think you buy this leading home builder.
Let's talk about that game last night, the Buffalo-Kansas City game. I mean, it was an amazing game. Who do you like this weekend, Buffalo and Baltimore?
Well, the Chicago Bears aren't playing, so I don't like the Bears. But at the end of the day,
neither's Notre Dame.
That's right. It's going to be a great matchup, and I think Lamar Jackson, has the ability to take him to the next level. So either way, I don't have a dog in the hunt, Ty, but I'm going to be rooting. Not going to have my shirt off like Jason Kelce, but you never know.
Yeah. Jeff, good to see you, man. Thanks.
See you, Ty.
Jeff Kilburg, KKM Financial. Coming up, the FAA recommending more Boeing planes go through inspections as 171 MAX 9s remain grounded following that Alaska Air door plug incident a couple weeks ago. The models impacted and what it means for the carriers, that is next.
Eastern.
Welcome back. The FAA recommending inspections for more Boeing aircraft. Phil LeBeau is on the news line with that story. Phil, this is beyond those 900 MAX planes?
Well, those are 737 MAX 9s that are grounded. This new safety alert is not for a MAX model. This safety alert, which was issued last night by the FAA, is for 737-900 extended range models. And essentially what they're saying is, look, we want the airlines that have these planes to do visual inspections of the mid-exit door plugs. So they're looking at the door plugs, much as that is at the center of the grounding of the MAX 9s right now. But here's an important distinction. Of these 737-900 ERs, these aircraft remain in service. They are not grounded. So why has this safety alert been posted? Well, the FAA says that some of the airlines that have these 737s, and by the way, these have been flying for a number of years, a lot of service with these planes. Some of the airlines were doing some checks of the door plugs once the MAX 9 issue came up. They reported what the FAA reports as findings about the door plugs, and that was enough for the FAA to say, look, you need to do visual inspections on these. There are 504 of these that are in service around the world. The bulk of them, by the way, flown by Delta, United, and Alaska Airlines. So as you look at shares of Boeing, keep in mind that the MAX 9 has been grounded, basically 2 weeks now, and we still see the pressure that's on the shares right now. And these inspections of the 737-900ER, most believe that they will be done relatively quickly. Again, these are visual inspections, and the aircraft remain in service. Don't forget, tomorrow morning, after the bell today, we get United's Q4 results as well as its guidance for 2024. And we will be talking with CEO Scott Kirby tomorrow morning about that guidance and, yes, about the MAX 9, because they do have 79 of those MAX 9 models that are currently grounded.
The inspection recommendation, does that apply solely to U.S. carriers or does it apply globally?
It's globally. I mean, when the FAA, they are the office of record, if you will. So even if you are a foreign carrier, when the FAA says we recommend that this be done because Boeing is a U.S. corporation,
right,
the foreign entities will do it as well.
Yeah, very interesting. And these are door plugs. Is that the sort of that rear exit that I'm looking at here? I don't know whether you can see what's...
That's the mid-exit. For your larger, and remember, the 900ER is a larger 737. It has the capacity to carry more passengers. Because you have more passengers, you have to have some way to allow for an exit if there is an emergency. And that's what the mid-exit door plug is there for. Now, it's covered up, but the whole idea here is on these larger aircraft, when you have that capacity, you have to allow that to be a possibility.
Is it an emergency exit or not? You say it's covered up.
It's not an emergency exit per se, but it is there. Because you have that capacity that is that much greater with that many more passengers.
All right, Phil, thanks very much. Phil LeBeau reporting on the 737. Coming up, Hertz becoming a battleground stock over its approach to electric vehicles. Morgan Stanley's Adam Jonas is bullish, while Jefferies is taking a more cautious approach. We will hear from the analyst who downgraded the stock about what has got her concerned. That's next.
A trial.
All right, welcome back, everybody. I want to draw your attention to shares of Spirit Airlines climbing higher again today as the company appeals its merger with JetBlue. The two companies announced after the bell on Friday. Shares are still firmly in negative territory since the merger was blocked last week by federal trade officials, but they have been paring those losses since then after Spirit announced upbeat fourth quarter guidance. 2024 has not been a good year so far for electric vehicles, with car rental companies phasing them out, shedding their fleets, and automakers slashing production. This morning, Morgan Stanley analyst Adam Jonas, remember the Jonas Brothers, by the way, said each day brings increasing signs of slowing global EV demand. And this could potentially get worse with another Trump presidency and the end of tax credits for those EVs. Our next guest just downgraded Hertz from a buy to a hold and says the EV problems aren't going to go away overnight, despite what Hertz has done. Stephanie Moore is equity research analyst at Jefferies. Stephanie, welcome. I love it when an analyst puts a stake in the ground, as you just have. I mean, you have cut the estimates on EBITDA by 40% next year to $500 million, lower than the consensus by more than $300 million. What's wrong here with Hertz?
No, absolutely, and thank you for having me. No, I mean, what we're seeing right now, it's really two factors that are coming into play. The first is that used vehicle values, particularly EVs, as you have noted, have decreased pretty materially on the EV side, but also broadly across the board, and that's certainly having a pressure on car rental stocks, but mostly Hertz, as you noted. The second issue is actually very unique to Hertz in that they are seeing elevated EV costs from higher damages and repairs related to these EVs. And these are higher damages and repair claims versus even, internal combustion engine vehicles. This is creating a lot of just lack of visibility into when these issues are going to actually subside over time. So while you noted we did cut our estimates to about $500 million in EBITDA for 2024, well below the street, which is at just over $815 million, we don't even have a lot of visibility and faith in even these cut numbers.
Is Hertz going to, what they're doing, I think, if I'm not sure I've got the percentage right, but it's about a third of their EV fleet is what they're getting rid of. Is that right? Or am I right on that?
Exactly. So they announced about 2 weeks ago that they were rebalancing their portfolio, and they were going where they will be selling 20,000 of their current 60,000 vehicles, which are EVs in the U.S. Look, I do believe that this is the right move, just given the cost headwinds that we have seen across EVs. But, look, to your point, they're only cutting about a third of their current fleet, and they'll go so that by the end of 2024, EVs will make up about 8% of their fleet. It had been about 10%, but note that, a year ago, Hertz was targeting that EVs would make up 25% of their fleet by the end of 2024.
They were pushing it. They were pushing it hard. Do you think they're going to get out of it? And will other rental car companies, now Hertz owns several brands, including Hertz, but will they follow suit here to the extent that they're in the EV world? And is Hertz going to get completely out of it?
Well, so Hertz was really at the forefront of EV adoption. They first started their kind of foray into EVs with some partnerships announced back in 2021. And the other EV companies really have not followed suit to the same magnitude of which that Hertz has. So I would expect to see that Hertz is going to be the one with the lion's share of the impact of selling EVs and kind of pausing this strategy, just given what we're seeing today. And what we're seeing is a couple factors. So, the original adoption that Hertz expected from EVs has not panned out the way they expected. You just have not seen the penetration, the demand from customers, all of which is coming into play where you're just not seeing the same, the adoption that they wanted. And then the other side of it is that you're seeing higher repair costs because, honestly, it's a little bit of a different vehicle to drive.
Well, it is a different. That's what I want to get at. As I give background here, you have your base case is an $8 a share stock, which is a little bit lower than where it is now. Best is $12 a share, and downside is $3 a share on Hertz. That's pretty amazing. I wonder why they're having such higher, not repair costs. I guess I get that, but collision costs and so forth. Is that because people just are not familiar with driving those EVs, and so they're distracted by the touchscreen, or what it is? Do you have any hunch?
Well, I don't know, Tyler, if you've ever driven a Tesla, but the first time I got into it, I was pretty surprised by how little you had to really press down on that gas pedal and you really don't touch the brake at all. So I think just the aspect of the amount of torque when you are driving an EV, it's just a little bit different, a little bit more sensitive. And I think you're just seeing, particularly in their rental fleet, not in their ride share, but in their consumer rental fleet, they are seeing a higher degree of accidents. And then you take this a step further, and accidents are one thing, but the majority of their EV fleet, it is Teslas. So what you're seeing is that Tesla does not have necessarily the repair, the repair infrastructure than other OEMs. So you're also facing higher repair costs dealing with parts as well as actual labor related to the vehicles themselves.
Very interesting, and you are so right. I actually do drive a Tesla, and they jump. They are fast, and they get moving pretty quick. You're not accustomed to it. You'll have a little pullback on it. Stephanie, thanks. Good to see you. Appreciate it. Stephanie Moore, Jefferies. And that pretty much does it for the exchange. Yes, it does. Coming up on Power Lunch, if you're looking for an entry point in the home improvement stocks, Oppenheimer says not so fast. That analyst will tell us when to buy. Contessa Brewer, she's right over there. I see her. I see her there. She's getting ready. It says here I'll join him on the other side of this quick break. That's not true. That's probably written for me when I'm over there. Contessa's coming. We'll be right back.
Now.
Welcome to Power Lunch, everybody. Alongside Contessa Brewer, I'm Tyler Matheson, and the rally is still rolling along off the best levels of the day, but still more record highs, including the Dow 38,000 for the first time. What needs to happen for this rally to keep chugging along?
All right, let's get a look at the numbers right now. Tyler mentioned that the Dow hit a record high above 38,000, a little more than a month after crossing 37,000 for the first time there. The S&P 500 also hitting a new record today. Now you see the Dow up 0.33%, S&P 500 the same, NASDAQ Composite up 0.4%. Now the NASDAQ Composite didn't hit a record, but the NASDAQ 100 did, which means the bigger cap tech names are outperforming the smaller names.
The little guys are trying to run and keep up. You can also see that in a chart of the Russell 2000, still about 25% below the all-time high it set back in November of 2021. That underperformance, one sign the bears are pointing to, but right now the bulls are winning. Let's bring in Mike Santoli for more on where the markets stand right now. How do you read the tea leaves, Mike?
Well, Tyler, the first thing probably to note is that a new record high in the S&P 500, especially after a long drought, and this one has been over 2 years, is generally more a show of strength that should continue as opposed to a warning sign that a top is likely in. If you look at the prior dozen or so, let's say 14 times where the S&P has made a new record high after a year without one, the forward returns are actually better than average, up 90% of the time over 12 months. Obviously, that's no guarantee. Clearly, there have been exceptions. And I do think one of the quibbles that people are going to point to is the unevenness of the gains, especially in the last few weeks, where you do have a small handful of the mega cap tech stocks carrying the weight. That said, I think we could take some comfort in the fact that it's also occurred as economic data have been better than expected, and the odds of a March Fed rate cut have declined, which suggests that good news for the economy is somewhat good news for the S&P 500 index, and by implication for most of the stocks and for the earnings outlook. So I would say a net positive sign, even though we maybe have not quite had enough payback from that fourth quarter rally in the average stock just yet.
All right. Thank you, Mike. Stick around as we want to keep the conversation going. Our next guest thinks the market is due for a pause. Let's bring in Brent Schutte, Chief Investment Officer with Northwestern Mutual Wealth Management. Brent, welcome. Good to have you with us. You heard Mike there talk about what history tells us, and history tells us that when the S&P, says Mike, hits a new high after not having hit one for a year or more, that the performance is usually pretty good. Is what you're saying, does it quarrel with that thesis, or does it just mean we're going to have a pause and then we'll pick up and move farther higher?
Unfortunately, I think it quarrels with that thesis. I think this time is a bit different, given kind of what's happened post-COVID and where we're at right now. Look, to me, I think a lot of the good news has been priced in. People see finally inflation coming down. That was something we forecasted. Now we're worried that inflation is moving from a COVID thing, which is what that was, to something of an end of a business cycle thing. So we're relinking to an economy that looks late in the economic cycle, where wages rise, they stay elevated, and that puts upward pressure on inflation, which is where we think we're at right now. And given that backdrop, we don't think the Fed is going to be easing policy anytime soon. Certainly if they do, I think they really risk a wage price spiral. And we think inflation numbers have bottomed out, but they are certainly showing signs of pushing back higher. So, for example, the Cleveland Fed median CPI is rising. Core inflation is kind of stalled out in the 3% area, as has services ex shelter, which is in the 5% area. And so we think, these things are going to cause inflation worries to come back. The Federal Reserve is going to stay tighter, and the market will actually experience some sort of a pullback in the coming months.
I see in my notes that you say we continue to forecast a recession. You're fighting the good fight there. A lot of people have given up that forecast. You have not. I wonder why, number one, you see that as a probability. But number two, if there's going to be a recession, why wouldn't you then believe that the Fed would be more inclined to cut interest rates to make sure that the economy doesn't slump deeply?
I am more inclined to believe the Federal Reserve will cut rates when they see a recession, but by then I'd imagine the stock market would falter if history is any guide. And so to me, that's kind of the sequencing. I think you will see the Fed eventually cut rates once they see the labor market weaken, but that tends to be a trending type of an index. And typically when the Fed cuts rates, it doesn't arrest the stock market decline immediately, nor does it arrest the recession immediately. And that typically has a period of negative returns, which I think is more likely than not. Look, last year we were fighting the good fight of inflation coming down and no one believed us. That's happened. This year I feel just as lonely as I did last year. I still think a recession is likely, just given that I don't believe the Fed is going to ease policy until you see that labor market weaken, which by then it's too late.
Well, listen, Brent, the voice crying in the wilderness is often correct. It's just unheard. Let me bring Mike back in here. Mike, we're looking for some data later this week. The fourth quarter GDP numbers. We're looking for the personal consumption expenditures price index. How much could those numbers move the markets?
I think, Contessa, pretty significantly. I mean, I think a premise for this market remaining on firm footing is the disinflation story has to remain believed and plausible, and it has to show up in those PCE numbers to some degree. I think there's some patience that we can have here, and I know the Fed is not going to be committing to rate cuts soon. I don't think it has to commit to rate cuts soon, but it also has acknowledged that there is room for making policy less restrictive, even if the economy hangs in there. And I think that's where the market is right now. The tracking numbers for fourth quarter GDP still look pretty good. Maybe we're not going to be quite as strong as 2% plus, but kind of muddle through economic growth and inflation coming down is a decent backdrop, but it has to be proven out in those numbers.
If the dour outlook, Brent, that you've predicted holds true, where do you see opportunity right now for investors?
I still see opportunity in fixed income, which yields 4.5% to 5% in investment grade, which I think is compensation for any near-term risk that inflation rises. Look, I think the Fed knows how to quell inflation. They've certainly been fairly aggressive, but they haven't gone all the way yet. I think they will eventually get inflation under control, and people buying bonds here with yields in the 4.5% to 5% area, with real yields around 2%, I think will be eventually rewarded for their patience.
Are there equity categories that maybe have not been participants in the rise so far that you like?
We do. You mentioned one of them in the opening. You mentioned the Russell 2000. The S&P 600 is a little bit higher quality index. But certainly, I think some parts of the market have already discounted the reality that we may have a mild recession. And that's the small cap area, which is 13 to 25% off its highs. It trades at 14 times forward 12-month earnings that aren't expected to grow. If you contrast that with the S&P 500 trading at 21 times forward 12-month earnings that are expected to grow 5 or 6%, I think that's the area for opportunity for investors who tend to think past the 3, 6, 9, and 12-month basis. I think that's where the gains are going to be had over the next few years.
Brent Schutte, the lonely guy, but a nice guy. He's just a lonely guy. But we like him. Brent Schutte, Mike Santoli, we like you too. It's all good. See ya.
Everybody among friends.
Thanks.
Shares of Apple rising once again today, up 4% in a week, close to getting back above $3 trillion in market cap. There you're seeing up 1.5%. The company, though, facing challenges on several different fronts in several different countries. Steve Kovac is joining us with a look at what Apple's up against here, what kind of headwinds there are for them.
Yeah, there's just a ton of regulatory and legal pile-ons on Apple so far this year, just in the last week and a half or so, and some restrictions being implemented on Apple's ecosystem. But more telling than that, it's how Apple responds and waters it all down. Let me give you some examples of the last few days. The Supreme Court last week declining to hear that Epic Games lawsuit. Now, Apple won all but one count in that case, and it's now legally required to let apps offer discounts by sending its users to a separate website in order to pay. Now, that, of course, would normally cost the app a 30% fee that goes to Apple. But look, Apple found a way around it, and it's still going to charge 27% for people who use those external websites for payments. And some other things going on. A concession from Apple, actually. Apple offering in the EU to let third parties have access to the wallet app. That means Square Cash and things like PayPal, for example, can start taking access to that. And another concession, selling the Apple Watch without that blood oxygen sensor in order to comply with a U.S. government import ban over a patent dispute. That's still being appealed, but right now, a kind of light version of that watch being sold instead. But look, we're still waiting to see so two big things coming up. How Apple responds to the EU's Digital Markets Act, which goes into effect later this spring and goes directly after Apple's lucrative App Store and other core services. In the meantime, you have other regulations coming up. There's this DOJ anticipated case against Apple that's going to be a huge antitrust case that's also in the cards here. But we're getting some hints how Apple will respond.
Can we put up a year-to-date chart of Apple stock? There has been a pile on here.
Yeah.
There's been a lot of trash on Apple.
I'm talking aside from all the downgrades that we started the year from.
Yeah, the downgrades. But the stock is pressing in on 200, right? Right. Is that year-to-date? Year-to-date, up 1%. Not wounded fatally here at all.
And 2 weeks ago, it was all doom and gloom because of those downgrades, because of these fears around a kind of lackluster iPhone cycle that they're in the middle of. But there's still tons of optimism regardless of all these headwinds.
But what's clear, and not just from Apple, but from other big tech, is that the European Union's trying to tackle some of these privacy issues around technology. And the DOJ and its big focus on antitrust issues, that it has an impact. And even if Apple has figured out a way to dodge and weave a bit, that they are still headwinds.
Right, that's exactly true. And it's going to be more fully realized, I think, in the EU starting in early March, because Apple is going to be forced, for example, to allow other app stores on their iPhone. It's going to be forced, for example, to allow these alternative payments. Now we know how they're going to get around that, for example. And various other things. And that all just chips away little bit by little bit into the profitability and those high margins that all these services have for Apple.
Have they been able to go back and start selling again those watches that had that blood, I won't say blood alcohol.
Blood oxygen.
Blood oxygen.
Maybe that's the next version of the alcohol one. Yeah.
Might be helpful.
Exactly.
Have they been able to continue selling it?
They're selling it, but without the feature enabled. So in order to comply with this import ban, they got permission saying you can still sell it, you just have to switch off that oxygen sensor. And they're going to keep doing that until they can figure out a way around it or the case is resolved and appealed. But in the meantime, there are other things they want to do with that blood oxygen sensor in future versions of the watch that maybe can't do right now until they figure out this patent issue. So the future of the app, look, Apple is really bullish on health. I don't have to tell you that. They've been talking about it forever. And a core marquee feature on the Apple Watch and being hit by in a regulatory legal way is a big headwind.
Couldn't they ultimately go to this company that has this, or maybe they take it and license it?
They could, and that's what Massimo, that's the name of the health tech company that's at the center of this. That's what they want. They would love to collect, $2, $3, $4 per Apple Watch sold. Apple went through that dance with Qualcomm. They're still going through that dance with Qualcomm. They don't want to do that if they can avoid it. It might end up going that way, but for now, they're going to fight it every way they can, which is telling. Instead of playing with regulators, it's telling how they're willing to go hard and fight beat by beat, country by country. And I think that's something people need to watch as these new headwinds start to come, especially that DOJ case and especially the EU regulations.
Yeah.
Steve, thank you.
Thanks, guys.
All righty, coming up, home unimproved. Oppenheimer downgrading the improvement giants Lowe's and Home Depot. The analyst behind that call joins us next. Plus, further ahead, big tech dominating the VC funding space with names like Microsoft, Amazon, Nvidia, Google spending around $25 billion on venture funding. Power Lunch will be right back. All right, more details coming in now on that takeover offer for Macy's. Hot news, and Courtney Reagan has been working the phones. What have you learned, Court?
Hi, Tyler. Yeah, so according to sources familiar with Macy's thinking, the department store's board basically just feels it evaluated the offer and it's just not executable. The price is too low at $21 a share. They point out that, look, we were trading above $25 a share last year. The financing isn't really all that clear, even with a letter from Jefferies. Neither of these parties, Ark House or Brigade, has ever run a company before. It's not totally clear why they are interested in Macy's or if they really want to buy it or are trying to potentially bid up the price to attract another suitor. So there does seem to be some interest, like other activists and investors in recent years. Starboard Value, Jana Partners, in Macy's owned real estate to try to unlock that value. But you might remember, it's really hard to actually do that, as previous activists ultimately realize and sort of walk away. Macy's has done what it can do to unlock that value themselves, of course, when and where possible. And, you know, these sources also say, look, Macy's is always going to take offers seriously. They're going to evaluate them, do their fiduciary duty, but in the end, they just don't believe that this offer really is a real offer, nor is it in the best interest of its shareholders. I've reached out to Ark House and Brigade Capital as well to get some of their viewpoints. We know that really the specialization for these companies is actually debt and real estate, specifically high-yield debt there. That's what Brigade Capital Management specializes in, and that Ark House is a PE fund with a specialization in real estate. And I'll bring you more when we have it. Contessa?
All right, Courtney, thank you very much for that update. You can see the shares on the move there. Meanwhile, shares of Home Depot and Lowe's both trading lower. They got hit with downgrades at Oppenheimer to outperform. The firm says the valuations might not reflect the real challenge facing home improvement retail, but adds there will be better entry points ahead. Here's the analyst behind that call, Brian Nagel. Hi, Brian.
How are you?
Let's talk a little bit about Home Depot and Lowe's. As a customer, they are brands that I know very well. Why are they so challenged right now? What about the current economic environment is providing such a challenge?
Yeah, perfect. Well, I mean, look, I think it's always smart to start any conversation on Lowe's and Home Depot and just talk about the underlying quality of these companies. These are very well-run companies, and over the longer term, very well positioned in what I view as a healthy sector. You know, my concern in my recent downgrades today is that we're still in this softer demand backdrop. Okay, and there's a lot of factors that contribute to this. I think one of the biggest remains a pull forward in demand into the pandemic. So we're sort of feeling the after effects of that. And we've obviously still have higher rates. Hopefully they're going lower, but they're higher at this point. So all that's contributing to what I think is still a weaker demand backdrop, and then hence weaker sales at Home Depot and Lowe's. I'm looking at these stocks. They've had nice moves up. They've traded multiples that are now pushing towards recent peaks. And I think that's where they're vulnerable here in the near term.
You've also lowered your price target. So, for instance, Home Depot, your previous target was $360. Now it stands at $345. And Lowe's, you lowered that from $275 to $230. Are those, if those price targets hold and the share price gets to that level, are those great entry points for investors?
Well, I think they're getting there, right? I mean, I think that's where the stock starts getting more interesting. We also, as part of the work that we published this morning, introduced what we call downside support level.
Just keep an eye on gamma levels here. We're bouncing around on 48.52, though there's still a gap that needs to be closed down below here if you follow my cursor. Just in here, all this stuff needs to be cleaned up right here. Could see a little bit of weakness in SPUs, but the hourly trigger is on the move to the upside on SPUs as well. So maybe we just close the gap into the Friday close would be right now what I'm mostly looking for. It's possible that you could also get a little more downside. That's that 80 million level down here with the yellow box.
$3 to 5 years from now? In other words, are they long-term winners in your view after they get past this decline in price in your view and decline in earnings?
Yes, let me answer the second part first, Tyler. Absolutely. So these are stocks, I think, longer-term investors. Long-term is not a perfectly defined term. Okay, but 3 to 5 years, absolutely. I mean, like I said, these are very well-run businesses, And the home improvement sector in the United States is a very healthy sector, and both Home Depot and Lowe's essentially dominate that sector. Long term, they're attractive. Now, in the near term, though, we're just in this malaise.
Yeah.
You know, we saw this through 2023. Okay, again, like I was saying before, it's a function of a pull forward in demand, higher rates, other factors. And my concern here is that just because the calendar shifted over to 2024, we're not going to get this immediate switch, if you will, to stronger trends within home improvement. I think it's going to take a while. I think it's going to take maybe till later 24 into 25 to start seeing some noticeable improvement. And that's at odds. If I'm reading sentiment correct, that's at odds with what the market is thinking right now.
Mm-hmm. All right. Terrific analysis there, Brian. Thank you so much.
Thanks for having me. I appreciate it.
Oh, you bet. Brian Nagel. After the break, SolarEdge shares higher after announcing sweeping layoffs. But even with that lift, the stock is down more than 70% over the past year. We will be right back.
I'm a member.
All right, welcome back to Power Lunch, everybody. As stocks are rising to new level highs, bond yields are pulling back. Let's get to Rick Santelli in Chicago for a full accounting. Rick.
Yes, Tyler. You know, we started out this morning with our 21st consecutive negative month-over-month change in leading economic indicators. And that if you want to know a worse period, you'd have to go back through a 24-month period from 07 to 09. That was the last time we strung this many negative months in a row. And Tyler's correct. Treasuries reversing what has been, for the most part, a lower price, higher yield 2024. But short maturity, 2-year note is bucking the trend a bit. Today, it's the only maturity that hasn't traded under Friday's lows yields. It's the only maturity. Now, as you look at a 2-day, you see what I'm talking about. And it's the only maturity that's been going in and out of unchanged. As you see this 1-month chart, we're hovering near a 1-month high yield close. Why am I mentioning this? Because it was really longer dated treasuries that led most of the rate increases over the last several weeks. But short maturities now may be taking the lead because the notion of how aggressive the Fed's going to ease is under review, and that's reflected in short maturities. And it's reflected especially today because at the end of the week, we have some of the most important metrics the Fed likes regarding inflation with the personal income and spending trove of data. And finally, a historic day may be coming. Harken back to 1989 when the Japanese stock market made its all-time highs and all-time high closes, just a whisker shy of 39,000. And here we are right now, around 36,500, at the best levels basically since 1990. Pay very close attention to this because many believe it's going to be a very important resistance level and may give us clues about the Japanese stock market, currency, and economy for the rest of 2024. Contessa, back to you.
Rick Santelli, thank you, sir. Shares of Solar Edge higher today after the company announced it will cut 16% of its workforce. Pippa Stevens joins us with more. Is this all about efficiency?
Yeah, so they're dealing with a demand slowdown and then product oversupply. And so they clearly need to cut their costs. And so what they said was they're going to cut 16% of their workforce, about 900 people, also slow down their manufacturing and in some cases then cut it altogether in other places. And then they also shuttered one of their e-mobility divisions. And so CEO Zeev Lando said it was necessary in order to align their cost structure with the rapidly changing market dynamics. By that, of course, he means that the market just has not turned around yet. We kept hearing that, it's going to bottom, demand will bounce back. That keeps getting pushed out. Now, Solar Edge, not the only one. SunPower, of course, last week announced their restructuring in December, and Phase also announced restructuring.
Why is there a slowdown in demand? Because I was under the impression that there are some state governments that have renewed rebates and tax incentives for people who are buying solar. And I don't know what the infrastructure plan looks like for commercial customers, but it seems like there should be more.
So for consumers, it all comes back to higher rates because it makes you very rarely pay for one of these systems outright. And so then you are getting a lease. And so when rates go up, that makes your costs go up. Additionally, there's a lot of focus on the price of your power. And so when we saw nat gas surging above $10 per MMBTU, there was so much focus on electricity bills going up. And so when there's less chatter about that, less focus on that, and the consumers aren't watching that as obsessively, they have less of an incentive because it's all about the spread between how much they're paying per month and what their electricity rates are. And so when that's not favorable, then customers in places like Texas and Florida, where power prices are traditionally cheaper, are not going to go solar at the same rate.
Pippa, thank you.
All righty, let's get to Bertha Coombs now for a CNBC News update. Bertha.
Tyler, the U.S. announced another round of sanctions today aimed at Hamas and an Iraqi airline. The Treasury Department says it targeted Fly Baghdad and its CEO for providing assistance to Iran's military wing and proxy groups in Iraq, Syria, and Lebanon. The airline denounced the decision and called on the U.S. to provide material evidence for the claim. The U.S. also sanctioned a network of Hamas-affiliated financial exchanges in Gaza. Lawmakers on the House Energy and Commerce Committee are calling on the Food and Drug Administration to give a briefing on heavy metal contaminated applesauce pouches that ended up on U.S. store shelves. The high levels of lead and chromium were traced to cinnamon from a manufacturer in Ecuador. And Dexter Scott King has died. The youngest son of Martin Luther King Jr. and Coretta Scott King was battling prostate cancer, according to the King Center in Atlanta, where Dexter King served as chairman. According to his wife, he died peacefully in his sleep. He was 62 years old. If you're a man, please go get your prostate, get that checkup. The earlier you find it, the better.
We've had a lot of those reminders in the news this past week. Bertha, thank you. Up next, our Clean Start series often covers climate startups raising big money. Today, we look at one of the firms that provides all that cash. It's next.
$2.69 a gallon. NYMEX natural gas February futures settle at $2.41. NYMEX WTI crude February futures settle at $75.19 a barrel. That's up $1.78 or 2.42%.
Do you want to stay up to date with the latest and be on the bleeding edge of news for non-farm payrolls? Then sign up today and get our special offer of Financial Juice Pro for a year's worth of our service for the price of 1 month and save 92%.
Bitcoin falls to a 7-week low below $40,000, last down 4.4% at $39,750.
Deals today.
A handful of big tech companies are becoming the biggest spenders in venture capital and in the race for generative AI. And there's a new nickname for the group. Kate Rooney is here with who they are and what they're spending and where. Kate.
Hey, Tyler. Yeah, we love a good acronym. The new one for this group is MANG. It's M-A-N-G. Microsoft, Amazon, NVIDIA, and Google. Altimeter Capital is a Apoorv Agrawal coined the term in a blog post where he points out that these four spent a combined $25 billion in venture money last year, making up a total of 8% of all VC funding in North America. That was up from just 1% a year earlier. And for data and AI startups, it's actually closer to about 30% of the total. The launch of ChatGPT really kicked off this spending mania. There has been a shift. Before ChatGPT, it was all about mobility startups. So think about Waymo, Cruise, or Rivian. Now the big tech companies are spending on anything related to large language model startups. Think of OpenAI, for example, funded by Microsoft. You got Anthropic, Inflection. Some are actually funded by multiple MANG names at the same time. And this, guys, may be a match made in heaven in many ways. So these startups are some of the MANG companies' biggest customers. They spend big on cloud computing and hardware. In NVIDIA's case, as Agrawal at Altimeter put it, whenever a new data or AI project launches, the cash register rings at the hyperscalers. The structure of these deals is also very unique. It's part equity, and then it often includes credits for cloud computing. That makes it hard for traditional venture capitalists to compete with big tech, also seen as a wing for MANG, since those dollars and credits eventually make their way back to the big tech companies. But some are actually questioning the strategy of this round-trip funding. As Benchmark's Bill Gurley puts it, this, quote, gooses revenue at big tech. He expects a, quote, massive mess in the end, guys. So we will see there. Back over to you.
So the companies, I just take Microsoft as an example. They will finance the tech startup, and then the tech startup spends money back at Microsoft. So it's a round trip.
Round trip. So that's what some are questioning. So they're getting these cloud credits. And on the startup side, it's a great thing because some of their biggest costs right now is cloud computing. So they say, great, we're going to get this massive amount of funding. We're also going to get credits to spend back at Microsoft. For Microsoft, they're saying, okay, we're going to invest in this startup, but it's coming back to us in the end. So it is sort of this recycled capital, and that's what some are wondering in the end here, how that actually ends up. But there are some historical analogies. Google, for example, has done this with advertising dollars for years, which Mark Cuban actually pointed out on that Twitter thread. So there is a historical analogy, but some are worried here.
You know, it's sort of interesting because a company that I cover, Vici, which is a gaming REIT, is actually going into offering credit to its tenants now, and the tenants are then paying back the rent, right? Yeah, but you're growing the business, assuming that at some point you're going to have more money coming in the door. It's that circular capital is super interesting.
You see it in real estate. That's a great point too, Contessa. With sometimes you'll get a discount if you see a Whole Foods, for example, come into a mall. They'll sometimes discount the rent for certain reasons. So you are seeing these interesting capital structures, but it comes at a time when overall venture capital is compressing. It's pulled back massively, except for this one bright spot, which is generative AI. And the big tech companies are really the ones funding it and propping up valuation. So it's making it a lot harder for the venture investors out here in Silicon Valley to keep up and say, all right, we can't give you billions of dollars in cloud credits. We can give you money, but we can't quite keep up with the pocketbooks at one of these big tech Mang names.
Makes sense. All right, well, thank you for that, Kate. I appreciate that. For our series on climate startups today, we're going to mix it up a bit. The next one marks 50 companies that we've profiled right here on Power Lunch. So let's take stock and talk capital with a special guest. Our senior climate correspondent, Diana Olick, joins us to go deep and dirty into Clean Start.
Well, Contessa, look, so far we've tracked $4.6 billion in venture capital into these 50 companies. Clean energy, clean tech, sustainable, anything and everything. But last year was rough. The dollar volume of VC funding going into clean tech and climate tech in 2023 was down 20% from 2022, and that according to PitchBook. But one VC, ArcTurn, is announcing here on CNBC today that it just closed its third climate fund with $335 million. This is the first big climate tech fund close of this year. So to talk about it, we have ArcTurn's co-founder and managing partner, Murray McCaig. Murray, thanks so much for joining us. When we spoke last week, you referred to 2023 as, and I quote, brutal for raising money for VCs in capital in climate. Tell us why it was so brutal and whether you think 2024 will be better or worse.
Yeah, well, 2023 was a tough year all around for all industries, and climate tech suffered a bit from that. But looking at 2024, there is an enormous amount of climate venture capital on the sidelines, and it's going to start moving this year. Particularly in the latter half of the year. So I would say in the first 6 months of 24 is an incredible opportunity to be investing in emerging climate tech companies.
Now, I know you don't like to pick a favorite child, that is a favorite sector within climate tech, clean tech, et cetera. But you said there are business models that you think are better than others. Explain why, and even if you could tell us maybe perhaps one favorite child within the sector.
Well, maybe if you think about one of our favorite overall themes is the electrification of everything. And within that sector, we love mobility and home electrification right now. These are two sectors that we think in 24 are nearing an inflection point. And we saw this in Norway with EV sales, where they went from 1% to over 80% in a very short time frame, less than a decade after they reached that tipping point. And so we are actively looking to place capital in that mobility and home electrification space. In the mobility space, we just made an investment in a company called Recurrent, which is using AI to provide a highly accurate battery health report for used EV buyers. Also in that space, we invested in Harbinger, which is poised, in our opinion, to be the Tesla of medium-duty electric trucks. And then on the home electrification front, we made an investment in Palmetto, which is a marketplace where Americans can go to both find and buy solar. And then Span is another really interesting investment in the space, a smart electrical panel for the home. So these are two sectors that have us very excited for 24.
And we actually covered Span as one of our clean starts. But I'd also like to ask you, who are the investors who are putting money into your fund, and what makes them different than perhaps some of the other climate funds?
Yeah, well, at Arcturn here, we've been around for over a decade now, and that has just allowed us to get to the point where we can start attracting a lot of this institutional capital that won't even look at you as a fund until you're on your fund 3, 4, 5, et cetera. And we've just finally reached that point. And, these are, some of the top investors in the world, but they also have serious decarbonization goals. And we're allowing them to both, achieve their financial goals, but also to kind of take the decarbonization that our portfolio is delivering and allow them to roll that up to help them meet those goals internally.
Wonderful. Great to hear. Murray McCaig from Arcturn, thanks so much for joining us. Back to you guys.
All right. And Diana, thank you for bringing us that fascinating interview. We have a new report today on the investigation into the trading scandal, which led to the resignation of 2 Fed officials. Megan Casella joins us now from Washington with the latest. Megan, what have you learned?
Thanks, Contessa. We have just received that long-awaited report, which finds former Fed Bank President Robert Kaplan and former Boston Fed President Eric Rosengren did not violate federal laws with their financial trading activity back in 2020. The report does, however, say that both officials created the appearance of a conflict of interest with those trades, which you'll remember led them both to resign in late 2021. The Fed's Inspector General today says that Kaplan's trading activity did not violate laws, rules, regulation, or policy. But the report highlights a lack of information, as it calls it, surrounding Kaplan's trades, saying he did not publicly disclose specific dates of some of those trades and other details. As a result, Kaplan's actions created what the report calls, quote, an appearance of acting on confidential FOMC information and, quote, an appearance of a conflict of interest. Now, a spokesperson for Kaplan today referred to 2 previous statements saying Kaplan adhered to all Fed ethical standards and policies. On Rosengren of Boston, he was similarly found to have created the appearance of a conflict of interest with his trades. We have reached out to him for comment as well. Contessa?
All right, I'll pick it up, Megan. Thanks very much, Megan Casella. Still ahead, a commodity commotion. Shares of agricultural trader AMD plunged 22% as the company suspends its CFO amid an SEC accounting probe. Those are never good headlines. We'll bring you the full story when Power Lunch returns. All right, welcome back to Power Lunch, everybody. Archer Daniels Midland facing an accounting probe, and Dom Chu has the details. Dom.
So ADM is having its worst day on record right now. The food processor and farm supply company is the subject of a probe by the Securities and Exchange Commission with regard to some of its accounting practices, specifically related to its nutrition business. Now, ADM has placed its chief financial officer on administrative leave effective immediately. It also lowered its full-year profit forecast as well. Now, that combination of factors has driven a large number of analyst downgrades, also price target revisions from analysts on Wall Street. Barclays, for instance, has double downgraded that stock to an underweight. It was overweight before. They cited, amongst other things, the company's announcement, along with other themes like weakness in the soybean market, more stringent spending from consumers. So today's move has Archer Daniels Midland hitting its lowest level since early 2001. So keep an eye on those ADM shares, guys. I'll send things back over to you, Contessa.
All right, Dominic Chu, thank you for that. Still ahead, Gilead's disappointing drug study. Shares of the biotech company tumbled toward 9-year lows following dismal lung cancer trial results. We'll give you the trade on that name and more in today's 3-Stock Lunch. That's next.
Whoa.
Brent crude futures settle at $80.06 a barrel. That's up $1.50 or 1.91%. Time for today's 3-Stock Lunch, where we look at the 3 big movers of the day. And here with our trades is George Ball, Sanders, Morris, and Harris. Up first, Affirm Holdings. The stock is up a lot today, about 4%, after being down more than 10% in the past month. George, welcome. What's your trade on Affirm?
Affirm can best be described as almost a cult stock, but not quite. It's got some of the Reddit, some of the contrarian speculators who like it, but I think it's a sell. First, the buy now, pay later stocks are apt to be hurt in the next quarter to half, either because the economy turns soft and consumers pare back, or because rates stay here for a year, in which case the cost of borrowing money for a firm and the other buy now, pay later companies is going to hurt their profit margins substantially. So if you want to gamble, maybe gamble on a firm, but affirmatively, I would probably rather sell the stock than be a pure speculator. The fundamentals don't justify its price today or really what it's done today either. It's better to be avoided than to be in it.
George, up next we have Gilead Sciences. The share's down more than 10% today after a lung cancer study showed disappointing results. What do you think of Gilead?
Gilead, and I want to say this very carefully, is a strong buy, but buy it later. The disappointing results with Toldivi are one phenomenon. Gilead has a large pipeline of 7 or 8 major drugs that will have phase 2, phase 3 studies coming with results in the second half of the year and the first half of next year. Look at the history of pharma companies. When you get ones like Gilead that have a portfolio of drugs under study and they get disappointing results, they gap down, they go into investment purgatory for 3 to 6 months, and then they do well as people focus on their product pipeline. So Gilead, I think, is buy, but buy it in 3 months. Don't buy it now, unless you want to wait through the purgatory period.
What would be the signal to buy, George? What would be the signal?
I think the signal is the passage of time. Wait until late in the second.
So keeping an eye on the markets here. The S&P
late in the
500
first
is still
quarter,
up around
early in the
0.3%
second quarter,
in the
and at
session.
that
The
time,
dollar
people
is
will have
actually
forgotten
regained
about
some
the
ground. It's up around
disappointing
flat now,
results
about
of this
1% in the green.
AGC drug, and they'll be looking forward. So it's simply a calendar, not a bell ringing or any other fundamental signal.
Gotcha. Let's move on to a sticky stock, 3M, the company on deck to report fourth quarter results tomorrow. Shares are flat today. Your trade, George, on 3M.
My trade would be to buy it before the earnings, buy it on the earnings, buy it after the earnings. There is a great deal of latent potential in Triple M. Its management is disparaged. And when managements are disparaged, they fight like rats with their back to the wall. 3M has a big moat of patents. With the spinoff of its healthcare business, it'll have 3 segments: transportation, safety, and consumer. And those are big, strong sectors where I think the management is going to do everything it possibly can to beat expectations, to have free cash flows that are higher than analysts are estimating. And right now, it's selling at a very low multiple of free cash flow, about 3/8 of what it was selling at 4 or 5 years ago. So a sneaky fastball is Triple M, not only as a big company, but one that has big upside from the current $108 price. 3M has a big potential to it, I think.
We began with buy now, pay later. We're going to end with buy now, buy later. George Ball, thank you, my friend. Appreciate it.
Thank you.
And closing time is next.
begins here.
We only have 2 minutes left in the program, and we have several more stories we want to tell you about, so we'll get right to it. New data show that cargo theft has spiked more than 57% in 2023 versus the year prior. Nearly $130 million worth of goods stolen in 2023. But since reporting cargo theft is not mandatory, the amount is likely much higher than this, according to CargoNet. And these would obviously be major thefts, probably done by organized crime rings.
Yeah. Okay, so as the insurance reporter around here, I'm frequently asked, why are our premiums so high?
Why? I want to know.
When it comes to car insurance, one reason is that people keep crashing into each other. Why? They are using their phones behind the wheel. This should be a big no duh, but here it is. The Insurance Information Institute is out with a release today that says insurers are spending more on claims than they collect in premiums, which means premiums are going up more. And the number one cause behind distracted driving
is cell phones.
It shouldn't take a study for us to know that, because even people who generally drive well.
Maybe insurers could improve their margins to the extent they have margins if they would not advertise quite as much.
They think
you can't get away from the ads. You can't.
On.
Very busy weekend of football. The Lions are one win away from their first Super Bowl. One of few teams have never been there. The 49ers overcame a 7-point fourth-quarter deficit. They have lost the previous 30 such games under Coach Kyle Shanahan, but the indelible image to many, Jason Kelsey, shirtless in Buffalo, stealing the spotlight from his potential future sister.
They don't like that. No way. And that Bills game sent Kelly into labor. We happily report she delivered a healthy baby girl this morning. Thank you for watching Power Lunch.
I blame it on Patrick Mahomes. The baby's not named yet. I think the name should be Taylor or Travis. Closing bell right now.
All right, welcome to Closing Bell. I'm Scott Wapner, live from Post 9 here at the New York Stock Exchange. And this make or break hour begins with the rally in stocks. So let's get right to your scorecard with 60 minutes to go in regulation to see exactly where we stand right now. That's where it is. We're in the green across the board. Dow trying to close above 38,000 for the first time ever, as Goldman Sachs, United Health, and Caterpillar lead the way there. Take a look at those stocks. Nicely in the green today. We're going to watch the indexes every move over this final and most important stretch. Apple, big story today. It's back towards $200 a share. A couple of positive mentions today on the street as well. Those, I don't know, 3 downgrades or so in the last 2 weeks seem but a distant memory. Keep an eye on Microsoft, too. It tries to top $3 trillion in market cap for the first time ever. It's been in the red, though, for most of the day. Of course, we'll see what happens here over this last hour. It is the Russell that's outperforming as small cap stocks get a boost from the markets broadening, and probably that drop in interest rates as well, which takes us to our talk of the tape. Just how far can this rally go? Let's ask top wealth advisor Cheryl Young of the Rockefeller Global Family Office with me back here at Post 9. Nice to see you again.
Nice to see you again.
You have
Scott.
a good eye on the market. You always do. That's why you're in the Barron's Hall of Fame. That's why you're one of Barron's top 100 wealth advisors since 2014. So now we are relying on this knowledge, these accolades. Where are we going from here?
You know, I think the market is priced to perfection right now. I mean, we just hit all-time highs today, which is exciting to be on the show today. I'm a little worried. And the last few shows I've been on, Scott, I was very bullish. I was doubling down on tech the last time we spoke in October. And valuations are a little bit stretched, so things are priced to perfection. One of my favorite names, I can't mention individual names, is down sharply in the days, Semiconductor stock. So any kind of...
Might start with an N, but we won't mention any names. I think I know where you're going here.
Any kind of shocks could cause some pretty big pullbacks here. So I still love most of these Magnificent Seven names.
Okay.
But I'm adding protection right now. I'm a rock climber, and I like to think of the markets as you get up higher in the wall, let's just put a little gear in and keep us safe.
Do you think the market's just gone a little too far, too fast since the October low?
You know, I just don't see that we're going to get 6 rate cuts this year. I'm guessing it's 3. I don't think it's going to happen in March. I don't think it's going to happen until at least June. And the markets are really looking for these rate cuts to extend the rallies.
You're all eyes bleeding here today, or what? Excuse me. This no movement at all. Nothing. Look at that. Just grinding. Not a goddamn thing happening. As we await earnings.
Goldman Sachs today, Jan Hatzius says first one's going to come in March.
Yeah.
Now, I know.
Burning theta. I just took a look up. I'm like, oh man, the market hasn't moved at all.
The market as well. So I think the rate cuts happening is very good for stocks. It continues the growth story. You know, there's a lot of areas that have not, as you know, participated in this market rally. So we're really hoping to see some broadening. We saw it a little bit.
Yeah, I'd like to see what she means by. I'd like to see what this person here. She's saying that the first rate cuts are coming this summer, and that it'll be good for stocks. I'd like to see what she's basing that upon. Any of you out there? I have a question for you guys. Hearing this person speak on CNBC right now, can you give me a historical example? There are some, but I know the reasons why in those historical examples they were positive for U.S. stocks. So if you know why the first rate cuts would be positive for stocks, what would be the reason for that? Because about 80% of the time in that first rate cut, the market actually crashes. So there are some instances where the market does not, but I want to know from you if you know the reasoning behind that. So if you can answer that, I'd appreciate it. Not only that, I always wonder when these people are on. I guess my other question here is, these other people that are on CNBC is part of their own bonds. So are they pushing a narrative that doesn't really match up with where their investments lie?
A lot of large cap CEOs are actually downgrading guidance outside of technology. It's really only in technology we're hearing upgrades in terms of the earnings outlook.
Don't you think that if there are these cuts, and let's just say it's 3 for argument's sake, but rates continue to come down, or at the very least stop going up, that's going to continue to be good for growth stocks? Because that again is, people like David Kostin keep talking about that just lower rates are going to fuel the growth trade.
We've seen this every time we've had lower rates. It fuels the growth trade. And you have to,
okay, so this woman here is talking about, so this woman here is pushing a narrative that's false. We're going to interject here for a moment on the stream really quick because she's really driving me fucking nuts. And we're going to take a quick look and see what we can see here. Give me a quick second here. She's out of her fucking mind, or she's lying to you 1,000%. We're going to talk about that right now. This one's on CNBC right now. She's pushing a narrative that is fucking false, and it's really driving me fucking batty here in the background. And I got a second here to chat, so we'll bring this up here. Give me a quick second here. So this person here on CNBC is pushing a narrative that it can be very false. Now, it doesn't mean every time it's false. We're going to chat about that right now and what she's stating to us on CNBC. This is where my concern is right here. So if you follow this, so this is a all the macro you need kind of a chart. Basically, if you're a cash market participant, what you need to know about when we get crashes in the marketplace. And I'm going to remove this right now here for you. I'm going to put it to the side here. And put this to the side here. This is the unemployment rate. You want to see, traditionally, you want to see the unemployment rate rising. You want to see rate cuts. And you also want to see the unemployment rate hit 2% and then ricochet off. So this one could be improved right here. Give me a quick second here. I'm going to improve this. This line is not accurate here. Hold on a second here. Right there. So you should see unemployment slam down into 2% and then bounce off and ricochet. We'll make that purple here for you. And we'll make the line solid and maybe like a number 2 or something like that so you can see it better. Maybe a number 3. There are some instances where now this is inflation down here, right? You want to see inflation, and you also want to see the velocity of inflation. You don't want to see inflation go down like this, per se, and touch 2%, or if you're a bear. But you do want like the slam down, the velocity and the downside tag of 2%, and then a ricochet to the upside, something more like this, right? Velocity in inflation. So what I'm showing you right there. Now, this person here is saying that whenever we see rate cuts, they tend to bode well for the stock market. That hasn't historically been the case. You can see here, you can actually see right here, there's a quick rip up, right? This is a violence and an upside move, but it results in a major downside move in the marketplace when you get these cuts. Okay, so there's the anticipation of rate cuts. There's the fuel in that, and then there's actually a larger roll. So you'll sometimes hear me on stream say things like, if they're anticipating a roll in March, you'll see a cocaine-fueled rally, but then that cocaine-fueled rally does result in a crash, stock market crash. So my point or my thesis here is that, if you're anticipating rate cuts, you're like, fuck yeah, we're getting rate cuts, and we begin to go higher, you should be in jubilation, right? And the reality is you're just looking for liquidity to drop the market down. Now, you could have short-term or mid-term some bullishness here, but the idea here is that it rolls. And we sometimes don't even get this portion. It just rolls to the downside, depending upon where we are. Historical examples, at least. So let's look at that and some prior examples of this in history. And I can show you more examples of this. This is another rate cut right here. This person's on CNBC pushing you a narrative, and there is a pause in rates, and there is the cut in rates, and you can see what that results in here. Boom, downside move. Erase everything that you thought was awesome sauce. Here's another example right here, right? You get the pause in rates. Whoop. And as a matter of fact, you had a cut here, right? And you had a cut right here that did result in some more climbing higher, but eventually pulled back. But the real cuts, the real rate cuts here, resulted in a downside move. So you get the point that I'm trying to make here, right? And we have example after example after example of this happening. There are a few times, though, when it has not happened. There are some examples of when that did not happen. You can actually see a rate cut here. A little bit more stiffness, pullback, but not the damage that you're expecting. This is back in the 1990s. But there are other, my point here is that there are other factors involved. You can see one right here, too. Nice pullback right here. Just grinding sideways, pullback right here in the first cut, and then continued downside moves. Now, this isn't 100% of the time that this happens, but it is enough that if you were to trade it, you would trade this with, you can go back all the way back to the 1950s on this stuff. But if you were to go back and look at all instances of rate cuts, they tend to they would lead to one of two things, either looking for liquidity to the upside, or you're to drop the market, or we just roll down unless there's some other reason for us to go higher. Typically, that has to do with some form of QE from the Treasury Department. There's some issuance stuff with bonds we were talking about earlier last week. You'd need to see that stuff for a positive outcome in rate cuts. So I always question what these people are talking about when they say things like, yeah, rate cuts are good for equities. I'm like, yeah, for how long? 1 week, 2 weeks? Do they just roll us straight down right there? Or instead of looking for longing the market for a month or two, I'm actually looking for liquidity to sell the market to the downside. We got some news coming out at the end of the month that I don't think will benefit or favor bulls, but there are people out there currently watching to see what that data is coming out from the Treasury Department. I believe on the 31st or 29th or something like that. But even watching this action in the market, this rise that we see in this market right now, it was, in my view, some sort of anticipation of rate cuts and then a major market downside move. So you're like, yeah, I'm super bullish here, Cap. We're going to 4,900. We're going to 5,000 or something. Then we get hit with a rate cut in March or May. If that were to happen, I would be looking for more of an exit liquidity, right? Instead of going to 5,200 or 6,000 or something like that. Looking for an actual roll in the market down, possibly even into that trough that we had back in 2022. So are you watching? Did you just miss when I went back in every single rate cut? You want me to show you all the way back to the 1950s? We can do that right now. Hold on a second here. They're none of them are different. They're all the same. We'll look at them again. I'll show you one more time so we can be fucking super crystal clear in this stupid shit, so that none of you are pushing false narratives out there on Twitter. Okay, I'll show you them all going back to the 1950s right here. Now, someone just made a comment, LOL, that was COVID. We have this one right here. Explain this one to me. This is back in 2007. Explain this one to me. This is back in 2000. I'm going to go to SPX really quick and show you a better. I'll show you all the way back to the 50s, and you start explaining that to me. Because I think a lot of you out there have preconceived notions on this stuff here, but you can get this stuff for yourself. Get on TradingView and pull down the Fed funds rate on its own scale, the unemployment rate, and the rate of inflation. You could also add in, if you wanted, the 10s and 2s, but the yield curve, but that's not as accurate. It historically leaves. It's only accurate about 60% of the time. Explain this one back in 2000 to me, please, if you can. Explain this one right here. Hold on a second here. Let me show you a bunch of these. Explain this pullback right here. Explain this one right here for me. We can go on and on and on and on again on these rate cuts here. This one wasn't so bad, but there was a pullback. We actually had a larger pullback further on. Here's another one back in the 1950s right here. Here's another one right here. We actually had a rate cut right here, and then just that pullback right there on cuts. So you can see those right there. But you can actually see when this stuff ends up happening. Go back, all historical examples of rate cuts. We only have a few. I think it's only like maybe two or three where when we touch that 2% inflation and we have unemployment ramping, that we did not get rolled to the downside. And as a matter of fact, if you look right here, right now, you can actually see the ramp kind of taking place here. This is the fraud moment in the market. So this is unemployment, right? This is where my thesis is: the longer they keep unemployment kind of around here doing this nonsense and not getting that full ramp right there, this is where the manipulation phase comes into the marketplace. Same on inflation. The more this inflation number kind of bounces in here and doesn't hit 2%, the Fed and the Treasury Department is prolonging that expected roll. And as a matter of fact, just by looking at this period right here, looking at this period right about here, this is going back to June of 2023, right in here. This is where the fraud starts. The longer they can make this market go sideways with these data points, the longer they keep these rates held sideways, the more the chances are, or the probability are, of this market to continue to the sideways and to the upside. It's the moment they begin to actually cut rates that I would be fearful as a bull. So I don't know. I guess I'm looking for you. I have someone's out there commenting. What do you got there? Yeah, fixed stripe matrix. Right on. Appreciate that, Trader Podcast. So I'd really like to know from you if something better than, oh yeah, that was COVID, LOL. That doesn't really fly. Some examples for when we actually do not roll to the downside. Now, there is a posit out there. I did read someone did finally post a story somewhere that the prime banks are lending to hedge funds to invest in the stock market. I did post that on the chat last week, I believe, on Friday. And then I posted something to, I think, Gammon or whatever his name is. He was talking about that same stuff. You want to be seeing the Treasury Department and the Federal Reserve doing some kind of more money, right? Money supply needs to increase, basically, in the market for that expansion that you're looking for. And you'd want the public to know about it That's another key part. You want the public to know about this before you cut rates.
That's up 300%.
Yeah, it's a good.
Yeah, I'll put her back on and talk blab again.
I apologize to my clients.
Right. Keith, let me give you the last word because we've heard of healthcare, financials, energy outside of the whole tech universe that Cheryl thinks can work this year. What about you?
We still like tech this year. I would say I expect it probably is going to consolidate after this big move up. Same with semiconductors. You're up 14% in a short period of time. But I would look at any pullbacks in that area. I think that will be leadership. We still like discretionary. Discretionary is a big sector. So I think you have to go underneath the surface, and some of the, more of the retail consumer side, I think is still positive. As inflation comes down and that real consumer spending is positive for the first time in several years, I think that's also, a good place to look. We're closely watching financials and healthcare for potentially an upgrade. We're not quite there yet, so we'll be patient for some of our work to move that way.
I'll give you actually the last word. I changed my mind when Keith said, when Keith said discretionary, we didn't talk about that. How do you feel about the consumer and retail-related names, restaurants, things like that play into that story?
Yeah, we talked about this last year, Scott. The consumer has been very strong through 2023.
Yeah, surprisingly so, right?
Shockingly. I mean, the retail numbers were shockingly good. But you look at credit card debts, you look at the interest rate on these credit card debts, and you look at what's happened to the savings rate. The savings rate has been cut in half. People have spent down their reserves. So sooner or later, that has to catch up with the consumer. You can't just spend money you don't have. I mean, people do. Credit cards are out there. But sooner or later, there's payback that has to be done.
All right. We will leave it there. Keith, thank you. We'll see you soon. Keith Lerner of Truist and the Hall of Famer, Cheryl. We'll see you again soon. All right, let's send it over Christina Partsenevelos for a look at the biggest names moving into the close. Christina.
Well, let's start with Union Pacific and Norfolk Southern. Both are getting a boost today as Bernstein upgrades the two rail giants to outperform. Analysts there think we're nearing the end of the downward trend that we've seen just as of late in the freight cycle and expect both companies to benefit from a rebound in the trucking market. And since we're talking about trucking, J.B. Hunt is higher today as UBS also upgrades the stock to buy despite its disappointing earnings report that we had just last week. Analysts say J.B. Hunt's margins have hit a bottom and it has a history of performing well during periods of improving freight cycles, and that's why shares are up 4%. Scott.
All right, Christina, we'll see in just a bit. That's Christina Partsenevelos. Zions Bancorp earnings are out, albeit a little early, right, Steve Kovac?
Yeah, about 45 minutes early only, and we're seeing shares up about 5% here, Scott. Let me just give you some of the results. EPS is coming in at 78 cents a share, though we're not comparing that because of the $90 million FDIC special assessment impact that's going on, so that kind of throws comparisons a little wonky. And then I'll also just flag here, Scott, net interest income down 19% to $583 million. We've reached out to Zions to ask why this came out early, but that's the numbers we got right now. Shares up about 4.5% right now, Scott.
I mean, you hit the wrong button at the wrong time. You hit the wrong button at the wrong time. We've seen this movie before. Steve, thanks. Steve Kovac. All right, we're just getting started here. Up next, trading key levels. Top technician Chris Verone is highlighting where he sees the S&P heading from here. The two sectors he's betting will break out. He'll make his case after the break. We're live from the New York Stock Exchange. You're watching Closing Bell on CNBC. All right, we're back with the S&P 500 on track for a record close for the second trading day in a row, and also pacing now for a third straight up day for the first time in this young year. Strategas' head of technical and macro research, Chris Ferrone, is here at Post 9 with me. Good to see you again.
Great to be here.
So you were last with me the very first trading day of 2024, and here we are. We've got some new record highs. Now what?
Well, I think what's interesting over that interim 2 or 3 weeks, it was a market that really chopped for about 2 weeks. Yet our kind of big call was there was no meaningful selling pressure under the surface. You know, when you're looking for a change in the character of the market, you're looking for really strong down days where decliners overwhelm advancers, and there was just none of that. It looked like a healthy, normal consolidation from that momentum surge in the fourth quarter. So we've seen this market break out. You can kind of get to 5,100 in terms of technical targets if you want to circle a level kind of in the distance. But for us, it's always about what is the character of a move, and I like to look to the cyclicals or the defensives, and this is a market still largely led by cyclicality. I think as long as that's the case, don't fight the trend.
Well, hasn't the character of this move changed in some respects? We had this broadening out. A lot of people were looking at small caps. Now, obviously, today they're outperforming, but that trade looked like it was fizzling, and money was just going right back to the tried and true mega caps.
I think there's actually a pretty remarkably attractive period for small caps in terms of them being timely. You had a epic momentum surge in the fourth quarter. You've consolidated that with a 6% correction, almost like so what, right? We're into support, 200 days upward sloping. I like the fact the last couple of days you've begun to see some renewed leadership from the smalls, today in particular. And, you know, look at this group, right? Small caps, it's banks. Banks drive it. And I think the way the banks have responded, not just the last couple of days again starting to work, but really the entire fourth quarter is suggestive of some small cap leadership here.
It's funny you say that because, I mean, I just had a conversation with a highly regarded and respected wealth manager who says watch out for the regionals because of all of the commercial exposure.
You know, something we always do in our work, we pay special attention to what the consensus perceives to be the weakest part of the market, right? So whether that's regional banks right now or office REITs, and we simply ask the question, are they behaving as if they're the weakest part of the market? And I think you could say pretty comfortably right now, neither the regional banks or the REITs are behaving as if they are still the weakest part of the market. So I think that's a testament to strength.
Is it? I just wonder, like REITs are performing well because rates have come down. Regionals are performing better because the economic outlook has stabilized and the Fed's already come to the rescue once, and there's no reason to believe if something substantial sort of melted up again that it wouldn't.
Well, take banks broadly here. Something like 80% of banks right now are in an uptrend. That's the best reading in 2.5 years. So the underlying technicals of the group give us confidence that a pullback or a correction in financials or in banks would be one you would want to buy here. I mean, the other place where you've seen really important internal improvement is healthcare. And I think importantly, healthcare strength is not extending to the other defensive groups. So this is just not some move into defensive healthcare or defensive future staples. This is healthcare working on its own right, which is a change in terms of what the leadership fabric of this market's been.
You want to tell me what the not just technical aspect of this move in semis means, but you know the macro reasons, or what justifies this move? And maybe there's plenty. I'm not trying to throw stones at it. It just continues to blow the mind.
I think what's important, we know the story of NVIDIA, we know the story of AMD. It's getting broader than that. I mean, the breakout in Taiwan Semi in the last 48 hours is meaningful.
Well, I mean, look, their guide last week is one of the reasons why tech sort of got restarted.
Importantly, equal weight technology. So, you know, moving away from just NVIDIA or Microsoft, equal weight tech just made new relative highs versus S&P today. So this is not 7 stocks in tech or 5 stocks in tech. It's actually pretty broad. And I recognize enthusiasm on groups like Semi is probably high here. And it's something one must be, or is high. It's something one must be mindful of in the first quarter, first half of the year. But it's hard to position against it until you begin to see the relative leadership deteriorate, of which has not happened yet.
I mean, this is the power of momentum. Exactly what you're talking about.
I mean, we're talking about today one of the highest readings in technology sector, 52-week highs in many, many years. That tends not to be bearish. You can consolidate from it, you can pause from it, but that's more of a signature of a bull market, not a bear market, and the internals from tech still reflect that.
Before I let you go, I mean, is there one thing that you look at and you say, well, this concerns me?
Yeah, I think it's always important to be like, what are the blemishes there, or what could disrupt this? Watch crude here. Crude over 77, 78 would be a change in character, and I would continue to emphasize the weakest groups in our work are European luxury and European auto. So LVMH, Hermes, BMW, Mercedes, for all this cyclical momentum out there, they're weak charts.
Because of China?
Let's presume that's the case, but I also want to be open to it's something we don't know yet, and I think that's the wisdom of the charts.
All right, we'll see you soon. Thanks.
Thank you.
All right, that's Christopher Owen, Strategist. All right, up next, Charles Schwab's Market Playbook. We get it today as stocks hit fresh highs. Kevin Gordon breaking down how he's navigating this trading environment. He'll join me at Post 9 just after the break. Closing bells coming right back.
I have another question for you. If you're in the chat right now, are there any, let me see what you guys are saying here. Are there any bots that you would like to see inside of our Discord? So if you're watching the stream right now, you're in the audience or something like that, you want to see any bots added that you enjoy, let me know. I'm taking a look at some paid bots right now in the background, adding them to the Discord. So if you guys know anything, let me know. Or if you have any like suggestions of stuff that you like. Yeah, like we can develop or we've got somebody that's willing to develop some bots for options flow, stuff like that. Put in the Discord, but I didn't know if there's anything you guys like. Sex bots.
All right, stocks are in the green across the board. The Dow and S&P hitting.
I was thinking about that with the.
Investors preparing for a big week focused on a wave of economic data, including the first reading of fourth.
Yeah, I like Trading Ticks and I like Clyde too.
Of earnings joining me now. Post 9 to discuss. Kevin Gordon of Charles Schwab.
I was just thinking about too. They want to like unleash AI bots on like banking, PayPal, stuff like that, right? And it makes me wonder if lonely people will try to fuck with the bots. I can't even imagine the can of worms that's going to open. like trying to crack or break a bot on like a banking phone line or something like that. I can't even imagine the ways to break into those bots and cause all kinds of havoc. I do like, I like Tradie Ticks. There's a couple other services out there that offer them as well. Let me check YouTube, see if they got anything here. Yeah, I don't see anybody commenting on YouTube.
It's not this, I think outright bullish, outright bearish way to view things. We look at it at a much more nuanced level than that.
Sure, but if I just ask you plain and simple, is the stock market going to do well this year? What's your answer?
I think the runway is improved if you continue to see what you and I have talked about a lot, which is this rolling weakness under the surface of the economy transform and sort of transfer to different sectors at different times. Because you look at certain sectors like manufacturing, particularly in the sentiment world, where a lot of that data still looks weak, still looks recessionary. If you were going to take something like the Empire survey last week, which got a lot of attention, doesn't portend a very strong reading for ISM manufacturing. And at the same time, you're starting to see more cracks underneath the surface of the labor market. But if that doesn't morph into this widespread weakness at the services level or at the overall labor level, then you don't go into a full-blown recession and you sort of continue to roll on with the unique nature of this cycle. All of that being said, that probably paints a better scenario for equities. And I think it's a much better way to think about it, where you kind of normalize. You go into an environment where you no longer have these huge divergences between large caps versus small caps, or the Mag 7 versus the rest of the market. That was very much the story last year, as we all know. But a character of a market that was November, December, where you did really start to see a broadening out. That's something that we would look for this year. May not be as great at the headline level, but under the surface it would be a lot better.
You think that was anything more than just run for the money heading to the end of the year?
I mean, I think there was definitely a lot of pressure that had built up and sort of pushed money, and that was itching to look for other parts of the market that hadn't done well. But at the same time, the breadth picture for even something like small caps has improved dramatically. Just look at the percentage of companies within even the Russell that are above their 200-day moving average. You've made a series of higher highs and higher lows in that index. So even though you've been in this chop phase since 2022, where you've gone up 20%, down 18%, up 15, down 10, for a considerable period of time, throughout that entire period, it isn't that breadth is weakened, it's actually started to strengthen.
So then I'm not suggesting you should be anything in your view of the market, but why aren't you more bullish if you're here pointing out this broadening that you think is believable, especially under the surface in something like small caps? Because money's gone back into the mega caps, so if you believe in the mega caps and now you believe in the small caps, aren't you painting a more bullish scenario for your own outlook?
And it's not a binary trade. I think one of the things, and I talked about this last time I was on with Mike, one of the things I think we get caught up in a lot is it going to be one group that has to do well at the expense of the other? I don't think that's the case. I think that both can do well, and that's why I talk about this more normalized environment where you can get to a scenario where if the economy stops sending these sort of late cycle signals, whether it's from the leading indicators or whether it's from the manufacturing and the housing side, which thankfully some housing data look to be turning and maybe not entering their own expansion, but at least firming up a little bit, that ends up being a better scenario for the overall market itself. But headlined index gains that you saw last year because of a couple of names that happen to constitute a large portion of the index, maybe that's not the case moving forward. But I'd much rather look for something that's a lot healthier, where you have participation under the surface improving at a much faster degree.
Sorry, how many rate cuts we getting this year, and when do they start?
Gosh, I don't know.
You're not modeling it in? How can you? I mean, you got to be thinking about how many we might get.
I think the discussion around rate cuts, if you're thinking about it as to when or how many, that to me is sort of missing the broader picture of why are they happening. So to me, it's tell me the economic data when we're at the first rate cut, and I'll tell you if it's a good cut or a bad cut, and I'll tell you probably if you're going to get more or less. I think if the Fed is
placing your bets now, though, that they're going to be good cuts, so to speak, because you're.
Yeah, this guy's doing a good job right now of explaining that there are good cuts and bad cuts right now. You want to listen closely to this guy.
Your word, rates. Bad cuts would be they have to cut because the economy softened too much.
Absolutely. I think that, yeah, in the scenario where they're easing a little bit, but you still have a lot more pressure from real rates because they stay elevated. I mean, think in the instance of inflation continuing to come down, let's say you continue to ease at a trend that you've been seeing over the past couple of months, maybe even over the past year, and the Fed only cuts 3 or 4 times, that still keeps real rates in pretty restrictive territory. I don't think that's a bad scenario if they think and the economic data prove that the economy can handle that situation. But at the same time, yes, if you have to pivot to more aggressive rate cuts, then they see something that's a little bit sinister under the surface, and then that probably means a little bit of a weaker scenario for risk assets. But I think that the unique nature, again, of the cycle is that you can't really pick out any certain analog from history and say, well, if the Fed is cutting at this point,
Yeah, I like the unusual whales bot too.
Basing your whole investment analysis off of just the Fed, I think, is a pretty useless exercise when you're not taking into account the economic data itself.
Really, I mean, because some would suggest it actually is that simple. Just don't fight the Fed. I mean,
no, because I mean, look at all the instances in the Fed tightening cycles going back, early 1900s, where you've had the final hike to the first cut. In 50% of those instances, the market was up, and 50% of those instances, the market was down. That doesn't tell me anything about that doesn't tell me anything about an investing strategy based on the Fed itself. You have to take into account the economic data. Look at an instance like 2019, where you could argue those were just insurance cuts. Obviously, the pandemic sort of ruined the trajectory from there. Market did fine. You still had economic data that was hanging in there. But look at an instance like 07 and then 2000, 2001, when obviously they were cutting for the wrong reasons.
But isn't your base case at this point that they're cutting for the right reasons, and if not, why?
Yeah, no, I do think if we stay in the current trajectory where you have a labor market that stays relatively resilient, I wouldn't call it healthy because under the surface there are still a lot of cracks. But then you have GDP growth that's holding up, you have labor force participation that hangs in there, and you have inflation continuing to ease back towards a trajectory that they're comfortable with, then yeah, they'd be cutting for the right reasons. It's just too soon to extrapolate that forward and say, yeah, a year from now, everything's going to be totally fine.
No, but you have to make your sort of market decisions and calls based on, we don't wait until the exact minute to see all by then the train's left the station, so to speak,
absolutely.
right?
Yeah, and that's why, our the way we think about being, if you're cautiously optimistic, or if you are optimistic, or even if you're pessimistic, you can stay pessimistic and reflect that in your asset mix. You can stay cautiously optimistic and reflect that in your asset mix. The key is staying invested throughout that entire period. And also recognizing that even if you have more of a defensive mindset as an investor, the post-pandemic era has told us that the concept of defense has shifted. It's no longer in the traditional utilities, consumer staples, healthcares of the world.
Yeah, right.
It's now in things like the mega caps. But look at what has been dear and what has been sort of missing for a lot of companies that have suffered in this current cycle is those that don't have strong cash positions, those that don't have high interest coverage ratios, a lot of the Mag 7 group, and even beyond that. I don't want to just, sort of keep it to that group itself, but even beyond that, they exhibit those qualities. So it's understandable why a lot of times now the knee-jerk reaction is to go into those names at the expense of the rest of the market.
All right, appreciate it as always.
Yeah,
Kevin,
Scott.
thanks. That's Kevin Gordon Schwab. All right, you too. Up next, we're tracking the biggest movers as we head into the close. Christina Partsinevelos is standing by with that. Christina.
Well, the SEC is looking into the accounting practices of one food processor, and a cancer drug trial did not go as planned. We've got the details next.
Early markets on close imbalance, still sitting at 483 million to the sell side.
Protect your trades from macro headline risk with Financial Juice Pro. Now only $99 a year for our real-time service.
Possible.
We have just about 10 minutes or so to go before the closing bell. Let's get back to Christina Partsenevelos with the stock she's watching. Christina.
Let's start with Gilead Sciences, heading for its worst day since 2014 after a key cancer drug from the company failed to meet its primary goal in a trial. The company says it will work with regulators to identify whether certain patients could still benefit from the drug, which is already approved and a top seller for treatments. You can see shares down 11%. And ADM is having its worst day on record as the food processor and farm supply giant faces an SEC probe. The agency is scrutinizing some of the ADM's accounting practices related to its nutrition business. The company is placing its CFO on administrative leave effective immediately and lowering its full-year outlook. And that's why shares are down a whopping 23%, Scott.
All right, Christina, thank you. Christina Partsenevelos, we will see you in the market zone. Still ahead, we're drilling down on the chip trade. Western Digital and AMD moving in opposite directions today. We're going to tell you why and what it might signal for that sector. Closing bell is coming right back.
Market on close imbalance, 1.2 billion to the sell side. At 4 p.m. Eastern Time, we get some data from South Korea. PPI year on year, prior 0.6%, and PPI month on month, prior minus 0.4%.
United Airlines reporting at top of the hour in overtime. We'll have that and more when we take you inside the market zone next.
At 4 p.m. Eastern Time, we get South Korean PPI year-on-year, prior 0.6%, and South Korean PPI month-on-month, prior minus 0.4%.
We're now in the closing bell market zone. CNBC senior markets commentator Mike Santoli here to break down the crucial moments of this trading day. Christina Partsinevelos is back, this time talking the rally in chip stocks, most of them anyway. And Phil LeBeau looking ahead to United results out in overtime. All right, Mike, we're trying to get 38,000 here at the close for the Dow.
Yeah, a little follow through. I mean, for the first 3 weeks of the year, the message here was, the market is, paying back in subtle ways for the rally in the fourth quarter, but it wasn't breaching any of the tripwires where you'd say, okay, something a little more sinister is going on. So it's still stayed in that routine zone. The breakout to new highs, as we've talked about, as other people have talked about, it tends to be more, bullish signal than warning sign. So all that in the books, you'd say, what would I look for if I were trying to find something to worry about? Credit's not really going to do the trick. The market did not really surrender the breath move of the fourth quarter. It definitely tested it. You're seeing it bounce again today. And I think that the willingness of the market to live with a firmer economy, better economic news, pushing out of the Fed's first rate cut, at least on paper, is a net positive.
Rates up for the right reason.
Yeah, rates up for the right reasons, and also people trying to readjust exactly how friendly the Fed's going to be. So I would say, all to the good on those fronts. And so in the absence of something new to worry about, aside from, the basic ebb and flow of the market needing to stay on the soft landing path, I think, things are in a decent spot.
Ton of earnings this week, so we'll see. The chip rip continues. Christina Partsinevelos.
Yeah, and I've got to start with NVIDIA because it's continuing that AI euphoria ride. The stock is up 25% year to date after soaring 240% last year. Recent bullish guidance from Taiwan Semi and Meta's plans to purchase more graphics chips for a total of 600,000 keeps NVIDIA top of mind and why the stock keeps hitting all-time highs like today. AMD, though, not getting the same love from analysts at Northland Capital. They're saying, yes, AI is big, but not as big as investors are thinking, which is why they are downgrading AMD on valuation to a heck if we know rating. They believe AMD's AI earnings potential is just a little too inflated right now. And Morgan Stanley making an interesting move, replacing NVIDIA with Western Digital as its top pick. They are giving the storage chip company a new price target of $73. That's why shares are climbing higher. The analyst Joe Moore says the stock is dirt cheap and memory prices are ripping higher. He also points to a split of memory businesses within Western Digital that's going to happen in the second half of the year, which should unlock value. That's why shares are up 4%.
Yep. Christina, thank you. On to Phil LeBeau, looking ahead to United Airlines. And Phil, both of us have had conversations in the last week or so with Delta's Ed Bastian. Nothing he said leads you to believe there's any weakness anywhere in terms of airline business.
Oh, no. Yeah. Not right now, Scott. I think in the fourth quarter, when we get these numbers, look, it was a strong quarter for demand and execution for United. Don't be surprised if we see strong numbers for the fourth quarter. But so much of what's driving the airline stocks right now comes down to guidance. And for United, three things we'll be looking for in their guidance. What's the MAX 9 impact? What do they say about the grounding over the last couple of weeks? The full year guidance for 24. International demand remains strong. And with regard to the MAX 9, keep in mind that about 9% of United's fleet is on the ground right now, and the impact will grow every day they continue to be grounded. Don't forget, tomorrow morning, Squawk Box, we'll be talking with United CEO Scott Kirby. You do not want to miss what he has to say, not only about the MAX 9, but also about this broader question of they got a lot of MAXs, Scott, that are due to start deliveries over the next couple of years. Is that going to get pushed out because of these issues at Boeing?
Yeah, absolutely. Phil, thank you. Look forward to that interview. That's Phil LeBeau, and we'll see you, of course, with the earnings in overtime. All right, Mike, so Dow is right now barely above 38,000. Russell 2000 ramping into the close, almost 2% today.
Yep, so you have a little bit of that catch-up money in there. And also, quiet in the bond market is helping that out. We talk about stocks being able to rip to a new high with bond yields going a little bit higher. Well, under the surface, the Russell 2000 is a little more sensitive on that front. So far, so good. And I don't really see investor sentiment getting overheated just yet.
All right, the bell's signaling that we're extending our records here. We're closing them up. We continue, though, in OT with Morgan and John.
It looks like the Dow did it, closing above 38,000 just barely for the first time. New all-time high there, as well as on the S&P. That's the scorecard on another record day on Wall Street, but winners stay late. Welcome to Closing Bell Overtime. I'm John Fort with Morgan Brennan.
Well, the march to new highs keeps rolling on as the Dow and the S&P close in uncharted territory. Second straight trading session we've seen this. Tech, once again, an outperformer. It's helping the NASDAQ 100 close at a fresh all-time high as well.
And now investors are turning their attention to United Airlines earnings just moments away. It's been a rocky ride for the stock over the last 6 months.
Turbulence.
Find out, yes, quite a bit for all kinds of reasons. Find out those numbers that are coming up can help turn things around.
Plus, we will discuss how the recent increase in Treasury yields is impacting the mortgage market when we are joined by United Wholesale Mortgage CEO Matt Ishbia. But first, let's get more on this record close. Mike Santoli joins us now from the New York Stock Exchange. Mike, and we could talk about, the top line numbers and the fact that we just tracked, new records and everything except the NASDAQ composite, which actually is trading at a fresh 52-week high. But the fact that you saw the Russell 2000 up 1.9% today, or the Dow Transports up 2.2%, it does seem like you're seeing that rotation out of just big cap tech, at least today, as this rally continues.
Yeah, Morgan, key comment, at least for today. This is definitely kind of the pendulum swings back and forth sometimes on a daily basis, but it is a net positive, I would say, that you didn't necessarily have a continuation of the complaints being drawn by the fact that it's only a couple of stocks. Coming into this weekend, NVIDIA added $250 billion in market cap. It was almost half of what the S&P as a whole has added on a year-to-date basis. That's a short span of time. But it is showing you that there's just a general sense of the trend tends to be in your favor once you hit a new high. There's quiet on the macro front, I would say. I'm not saying it, this is a wonderfully growing economy or we've totally escaped the late cycle shadows that are out there. But the market's a little bit more comfortable here. And I think more to the point, the market reset a little bit. You had that hesitation for 3 weeks and flows have not been aggressive. So people probably seeing all-time highs, maybe feeling as if they were not quite invested enough to play them.
Mike, I'm looking at the numbers, and Apple is just about dead even year to date, in the month of January so far. NVIDIA's up a little better than 20%. Tesla's the one of the magnificent seven, so-called, that's lower, about 16, 17%. So I wonder, is NVIDIA now the defining stock of this rally?
Yeah, I think it has been for a while now, and I think it took the place of what Tesla had been, let's say, in 2020 to 2022, which is, this company, founder-led, charismatic leader. It's going to be saving the world or changing the world. And this, basically open-ended growth estimates you can just apply to the business. And basically it has a cult following. Let's just be honest. If I look at the dollar volume of trading in either the shares or the options, NVIDIA is basically now on par or better than Tesla on a lot of days, not to mention the overall market cap. So yeah, it's sort of the source of a lot of the confidence, the speculative energy in this market, for better and worse.
Okay, we'll see you again in just a moment, Mike. In the meantime, United Airlines earnings are out. Phil LeBeau has the numbers. Phil.
Morgan, this is a beat on the top and the bottom line by United Airlines in the fourth quarter, earning $2 even a share, well above the street estimate of $1.70 a share. Revenue coming in at $13.62 billion, better than expected there. And then there are the numbers within the numbers in the fourth quarter. Total revenue per available seat mile down 4.2% compared to the same quarter in 2022. Cost per available seat mile up 4.9%. compared to fourth quarter of 22. Capacity up 14.7%. Gives you a margin in the fourth quarter of 6.2%. By the way, free cash flow, negative $3.08 billion. Now the all-important guidance, and this is what's going to be driving this stock after hours and tomorrow morning. A wider than expected loss in the first quarter of between 35 cents and 85 cents a share loss. A loss expected of between 35 and 85 cents a share. The street is expecting a loss of 21 cents a share. Total revenue per seat mile expected to be flat compared to a year ago. Cost per seat mile up mid-single digits year over year. And there is one important note regarding the 737 MAX 9. Remember, United has 79 of those that are grounded, have been grounded for the better part of 2 weeks. They are saying right now that if this continues through the end of the month, they expect it to be a 3% CASM headwind, cost headwind, if it's through the end of this month. And again, we don't know when this grounding of the MAX 9s may be lifted. Finally, full year, they expect to earn between $9 and $11 a share. The street is at $9.58. Lots to talk about with United CEO Scott Kirby tomorrow morning on Squawk Box. We will be talking about this guidance for the first quarter and their expectation for getting the MAX 9 back into the air, as well as delivery cadence for all of the MAXs that are scheduled to be delivered not only this year, but over the next couple of years, because, guys, many people are speculating that Boeing will have to push out any increase in 737 MAX production. We'll talk with Scott Kirby about that tomorrow morning.
Looking forward to your interview there, Phil. And we see the stock up more than 5% after hours in overtime at the moment. That would take it back above $40 a share, where it was a week and a half ago. Let's get to our market panel. Joining us now, Paul Christopher of Wells Fargo Investment Institute and Mimi Duff of GenTrust. Looking ahead, guys, I mean, Paul, we're at these record levels, but you say it's time to get defensive because the overall S&P is expensive, too many rate cuts priced in, and earnings are overall going to disappoint?
Yeah, I mean, we've been defensive for a little while now. I mean, we're still neutral on tech. We want our investors to get the full benefit of the upside in the market, but it's just too much. A lot of earnings priced in, maybe earnings fully priced, a lot of optimism about the Fed, maybe overdone, and the economy still slowing. Look, earnings have beaten so far for the fourth quarter 6% over forecasts. That's an improvement over Q3, but less than Q2 and Q1 of last year. So the trend in earnings clearly down. We would just be a little bit defensive here.
Okay, and Mimi, you seem to agree that the S&P is too expensive, but here's my pushback on that. The equal-weighted S&P isn't that expensive at all, and large cap tech has this AI tailwind that we've been seeing in NVIDIA. So isn't it possible there's a good reason why stocks like NVIDIA are expensive and that smaller names in the S&P are cheaper for an equally good reason?
Yeah, I think you make a good point with the rest of the market not being as stretched. One way that we like to address that is we have allocations to small and mid cap, and you can see today the Russell performing well. That's a healthy thing to see a greater amount of breadth, which we have seen in the past couple months. So that's kind of how we're addressing some of the richness of this magnificent seven.
Paul, I realize that yields came off a little bit today, but we had a big run up last week. And my question on this is, why is risk appetite so robust in the face of yields and money market rates backing up in general since the start of the year?
Well, I mean, rates have backed up just a little bit, but you've still got the Treasury very supportive of the short end of the curve. And then what that's doing is to create a lot of demand, a lot more demand than there is supply for longer-term Treasury notes. That's pushing longer-term yields lower. And if you have a really long duration bet on AI or anything that's tech-related, what would you like best is to have a really low discount factor to put against it. That's why we're neutral on the tech, but we would agree with Mimi. Here's the chance to really get into some things that are cheaper priced. We like industrials, we like healthcare, we like materials, and really we've just gotten back into energy. We think there's value there.
Yeah. Mimi, just to dig a little deeper into the earnings piece of this, I mean, if the market is arguably too rich, or we'll say maybe fairly valued, I mean, how much is going to hinge on earnings growth being realized in a robust way this year? And I ask that realizing that obviously the macro and this idea of a Fed back in play are going to be in focus as well.
Yeah, we agree. There's a lot priced in. The bar is high. And I would say that the landing strip is fairly narrow to land the plane perfectly well. We probably have higher odds of recession penciled in than the market does, for certain.
Paul, one of the areas where you seem to disagree with Mimi is on the small caps. You say that they would underperform on pullbacks. So what do you do with small caps?
Yeah, we've been underweight small caps for a while. They underperformed last year. We think they're benefiting here from liquidity, the courtesy of the U.S. Treasury. There's a lot of broadening out of this market right now, which people are taking as a comfort, but we think is more liquidity driven. We would stay underweight here, small caps. That would probably be one area where we would differ with Mimi.
All right. Well, that's what makes a market. Paul, Mimi, thank you.
Thank you.
And right now we've got a news alert on the hack of the SEC's X, formerly known as Twitter account, nearly 2 weeks ago. Eamon Jabbers has details. Eamon.
Hey there, John. The SEC is sharing a couple of new details about how its social media account was hacked earlier this month. In a statement just posted to the Commission's website, the SEC says the attack happened as the result of what's known as a SIM swap. That's a kind of a fraud in which a hacker transfers a person's phone number to a different device without authorization. In a SIM swap, the hacker then receives calls and text messages that are meant for the victim, and they can use them to foil security checks on an account. The SEC says access to the phone number occurred via the telecom carrier, not via SEC systems. SEC staff have not identified any evidence that the unauthorized party gained access to SEC systems, data, devices, or other social media accounts. Once the hacker had control of the phone number associated with the account, the SEC says the hacker reset the password for the @SECGov account on X, formerly known, as you say, as Twitter. The SEC says it doesn't know how the hacker knew which phone number was associated with that social media account. One other interesting point here, the SEC says that multi-factor authentication, a basic but important security measure, was previously in place on this account, but the SEC staff requested that it be disabled in July of 2023 due to issues accessing the account. That security measure was then not in place on the date of the hack. We don't know exactly what the issues were that led the SEC staff to ask for the security measure to be removed, but I am told by a source familiar with the situation that the SEC has now, guys, changed all of the passwords on all of its social media accounts. Back over to you.
I'm not surprised to hear that. I mean, this does sound pretty sophisticated, Eamon. Just a quick question.
Yeah.
I realize this investigation is still sort of in early